as long-term, total return-oriented permanent funds. Blue shading reflects the income-focused funds, the largest of which is the Common School Permanent Land Fund, but also the Higher Education Fund. Yellow is the Workers' Compensation Fund. You've got Pool A, the LISRA, and the State Agency Pool. If you turn to page 4, just a couple of high-level comments on performance. You know, this is the fiscal year ended June 30th, so that column that says FYTD, that's fiscal year to date. That's also the exact same number you see under the 1-year column. And the total fund is everything that I just walked through on the pie chart on the previous page. So it's a mix of funds with very different purposes, you know, all the way from, you know, very long-term oriented total return endowment funds to very short-term conservative state agency pool. So the total in and of itself isn't really a meaningful number because it's such a mishmash of funds with different purposes. But there's two things that I think are relevant here as we look at this total fund number. And the first is the performance against the benchmark. So that total fund index is a roll-up of all of the underlying total fund benchmarks of those funds I walked through on the pie chart, weighted according to the asset weighting that they represent. And so when we do compare this total fund to the benchmark, that is a good net of fees assessment of how has the management decisions performed. Everything from, you know, tactical overweights or underweights to underlying manager performance. And when you roll that all up, it was a good year. Net of fees, positive 0.8%. That's a very healthy level of outperformance. And the other thing that I would note here on this total fund number is just keep in mind that as we look at this 1-year period of time, stocks were down substantially. You know, anywhere from an 11% loss was about the best number for the year. That was on the S&P 500, large cap US stocks. Small cap US stocks were down 25%. International stocks were down 20 to 25%. On top of that, bonds were down. If you just look at the aggregate bond index, which is investment grade, safe, fixed income, bonds were also down substantially. In fact, they were down about 10% over this period. So it wasn't a year where, you know, you just by being more conservative, you were able to preserve value. But it was a year where diversification was very valuable. So I think the fact that the total fund is only down 4.5% in that environment I just described really is a testament to diversification more than anything. And the efforts that everybody involved in this program over the past, you know, 5 to 6 years, especially as the diversification of these portfolios has really blossomed. You saw a pretty significant benefit to that last year, and you can see as you look at the bar chart on the sort of bottom portion of this page, that just shows you the performance of every asset class that's in the policy, as well as the benchmark for that asset class. And you see some things that did really well. MLPs, which are primarily midstream energy assets, those did very well. Private equity, which has been a focus to build out over the past several years, positive returns. Real estate also performed quite well. The things that did well in this period of time are generally things where the cash flows are more directly tied to, in a positive way, to inflation, like with energy assets and real estate assets. The things that also did relatively well are things that just have on the fixed income side less interest rate sensitivity. So you've also got things on here like bank loans, which tend to be primarily floating rate instruments. So you're taking credit risk, but you're not taking interest rate risk there. While bonds were down, bank loans were only down about 3% thanks to their floating rate nature. And you've also, as part of the transition strategy into some of these less liquid asset classes, you have a decent chunk that's just sitting in what we're calling a transitional low duration account. So not taking a lot of interest rate risk there either. And as a transition strategy, that's worked out quite well in this environment. As you go to page 5, I won't read all of the numbers on pages 5 and 6 to you, but just if you want to kind of focus on that 1-year number or the fiscal year to date number and go down the page here, you can see that the performance of the different funds, permanent mineral down about 4.5, so pretty much right in line with the total fund. Also 80 basis points or 0.8% better than its benchmark. Common school actually a little better than that last year, down 3.9 and about 1.1% better than its benchmark. Workers' compensation, that is where you have more interest rate sensitivity in the assets because you're actually hedging the interest rate sensitivity of the liabilities. So that actually had some of the worst performance last year from just an asset perspective, but keep in mind that's intentionally offset against the liability side of the balance sheet for the workers' compensation fund. You've got LISRA in total on page 6, down 6.2 over the year. Pool A down 5.4, and the state agency pool at minus 2.6. So, Mr. Chairman, that concludes my prepared comments on performance. I would stop there and be happy to answer any questions that you have.
All right, thank you. Questions for Josh? Questions for Josh? Any questions? I don't see any questions, Josh.
Josh, can you give us a rough scenario of where, this is as of June 30, 22. Where are we today in terms of just overall market performance?
Mr. Chairman, Representative Nicholas, let me check my phone and see how markets are doing today. Just kidding. That's unfortunately, that's kind of where we're at. Looks like today maybe we're making some ground back, but July was actually a positive month. August took some of that away, and September has probably taken the rest of that away. We may actually be back kind of in a similar neighborhood, at least as to where we were on June 30. But as you know, markets are incredibly volatile right now, and that answer is changing depending on which day you ask.
Okay, thanks. All right. With that, I think Josh, I think we'll hear from you here in a minute about some other things. So I think that takes us now to impediments to investment earnings. And I think that brings Polly, I think you and Representative Nicholas have some stuff for us on our subcommittee update.
Okay, thank you, Mr. Chairman. Polly Scott, LSO Budget Fiscal, and the subcommittee on, okay, sorry. Is that better? Okay. The subcommittee on impediments to investment performance asked me to briefly summarize the report that's in your materials, and it is item 7-01 on the website, and it's also in your materials. As you know, Chairman Perkins created a subcommittee to study and develop recommendations and draft legislation pertaining to impediments to investment performance. Since the Select Committee's last meeting, that was in July, the subcommittees met twice. Once in August with the Chief Investment Officer, the State Treasurer, and the staff of the State Treasurer's Office to learn more and to ask more information, and then once in September to develop their report. And I can share my screen and just put the report up. Okay. Page 1 has an executive summary. The subcommittee focused on 3 areas: the total rate of return investment strategy proposal, legislative stabilization reserve account or LSRA obligations, and also public purpose investments or PPIs. And going in reverse order, when the subcommittee reviewed information about the public purpose investments and asked more information from the chief investment officer, they came to support and concur with the work the Joint Appropriations Committee is doing in that area to reduce the statutory maximums for those programs. And they did not feel that additional work needed to happen with the select committee, but they're going to keep informed about that and bring it to your attention if needed. The legislative stabilization reserve obligations are later on in the agenda.
Polly, before you move on, just so when we go back, the PPIs in particular we're talking about, are those, for example, is that the capital improvements? It's the loans, it's all that stuff that is the capital improvements, it's loans. Like, for example, I think we had $200,000 in various things that, $200 million in various things that municipalities and counties could invest in, and then it was based upon how fast along the payout or the term of the loan was that set the interest rate. Those are the PPIs are those some of the PPIs that we're talking about and you're referring to when you talk about the work that JAC is doing and reducing the statutory maximum for those public purpose investments?
Mr. Chairman, yes, and I've put up on the screen attachment C, which is in your report, and these are really the public purpose investments that the subcommittee was talking about, primarily the public purpose investments coming from the Permanent Mineral Trust Fund. And the subcommittee reviewed the testimony of the state treasurer's staff at the June JAC meeting, where they quantified, gave a rough estimate of the opportunity cost for those investments at about $6.5 million for the last year. But then the subcommittee had further outreach with the chief investment officer, to learn that there is additional costs involved in that if they need to liquidate something, and there would also be it would be problematic if there was a sudden increase in the awards for public purpose investments, and so that I think the subcommittee has in their report that they support the Joint Appropriations Committee work to reduce those maximums in statute. Okay.
Yep.
Okay. So if we can, we'll save the LSRA obligations for later on the agenda. And that takes us to the total rate of return investment strategy, or TRR. As you know, the proposal was developed by the chief investment officer and the accounting team at the state treasurer's office in consultation with the investment funds committee and RBK consultants, as well as the state loan and investment board. And the report does summarize part of that proposal just for educational purposes. But as you know, the main thing that the subcommittee was looking at was really what would have to occur legislatively if they were to move in this direction. And so table 1 there on the screen shows you the eight funds that the total return proposal proposes to move into this TRR strategy. And the subcommittee, in dialogue with the state treasurer's office and the chief investment officer, it came to light that Pool A is a fund that's going to require special consideration before moving them into a TRR strategy. And the subcommittee asked the treasurer's office for an implementation timeline if they were going to move, to a TRR strategy. And the treasurer's office included outreach to the individual participants of Pool A in their work that they would do if they were moving in this direction. That implementation timeline is also in your materials from the state treasurer's office. And so that was very important and something that the subcommittee wanted to be handled with sensitivity and a lot of outreach to those individual participating funds. To move to a TRR strategy, the CIO identified a need for the higher reserve account levels in the range of 5 times to 7 times annual spending, less a conservative estimate for annual dividends and interest income. And it was agreed to use 2% for that assumption. And that's based on historical Craig assumptions. The subcommittee in their meeting felt that additional information was needed about the sufficiency of the 5 times annual spending to 7 times annual spending, and they asked RVK to do additional analysis on that. So that's going to be available later today. At the bottom of page 3 of the report, you'll find the subcommittee's recommendation, which is to move forward with legislation supporting a TRR strategy. And the subcommittee really viewed this as a starting point for the select committee to go forward and continue to work on the legislation. But they developed 23 LSO 181 for further consideration. As currently drafted, the bill would set higher thresholds at which the reserve accounts tip money back to their respective corpuses. And it would allow the reserve accounts to reach the 7 times annual spending obligations. And then the legislation also directs transfers from the LSRA to each of the 4 reserve accounts, the PMTF, the Common School, Hathaway, and Excellence in Higher Education. And I want to switch to another handout that you have. It's been passed out, and I'll show it here. This is just showing you a summary of what's in the draft legislation, and it's got the current statutory maximums for those 4 reserve accounts, which are 150% of the annual spending policy. In the case of the Hathaway, it's a little different. It's 4.5%, and that is not correct on that slide. It's 4.5% of the Hathaway 5-year moving average corpus currently. And so you've got the 5 times annual spending percentages would be there, and the 7 times annual spending. And the bill is drafted currently with the 7 times annual spending. So these percentages are set, and they're based on the relationship between the spending policy and the assumed 2% interest and dividends. And so those are not going to change, and the committee can adjust those in the legislation as they desire. The second table there is an estimate of the transfers that would be needed into those 4 accounts to raise them to the 5 times annual spending level. And the total for all 4 of those accounts comes to $687.5 million. And I want to emphasize those amounts are preliminary LSO estimates that will be revised after October Craig, when we get our final spending policy transactions completed. And we'll come to you in November with the final numbers, and you can expect, some of them will go up and some of them will go down.
So if I understand that, we look at the second chart, which the 5 times spending, the total 687,500,000, 687 million, and the other one's 1.7 billion. And what that is that's basically taking that number, subtracting the anticipated year-end current value of the reserve, and then that's what would be needed, each one of those individual funds to bring that reserve account up to the 5X?
That's, Mr. Chairman, yes, that's correct. And the number for the 7 times is 1.262 billion. And that, yeah, that's what it is. It's subtracting out that 2%, making the assumption that that 2% is going to be used for spending. It's never going to hit the reserve account, increase the reserve account. So we're really just bringing it up to either the 5 times or the 7 times less that 2%.
Okay. And the concept is that by increasing these reserve accounts this much, that we have so much more coverage for the annual operating requirements from those funds, that then this can be invested as part of these funds then can be invested as part of the total return. Is that the right assumption?
Mr. Chairman, yes, and it's not necessarily the reserve accounts, but the corpus accounts that would be able to be in the total return strategy because of the increased reserve.
Right. Okay.
Mr. Chair.
Go ahead, Representative Schwartz.
I'd like to go back a step and talk about the tips. And I guess my question is why we need any tip to the corpus, given the way we're revitalizing.
In case you have tips.
I mean, I don't see what, we can always put money. We could always put money in the corpus, but why we would mandate a tip, given that we're equalizing the investment strategy, doesn't seem to make any sense to me.
Go ahead, Representative Senator Hicks.
Where my colleagues are going.
And you don't want to
Given the nature
go.
of my relationship with him, I think I know. So the answer to the question is the reason at some point in time, and this, to a certain degree, I think the 5 times, I think getting back to our earlier discussion with Don as far as saying legislative intent, we may not want to tip that until we got to the 7 times in the reserve account. And that would be part of that legislation. But the answer to the question is so it doesn't get spent. So that's why we get to the corpus. I mean, just for edification at some point in time. I do think if we go down this road, that we should set the objective of starting out at 5%, 5 times the reserve account with a target of 10. And so any of those revenues above and beyond the spending policy would just stay in a reserve account until we got to the $1.262 billion. That's when the tip would kick back into the.
I anticipated that response from my colleague, and I get it, and that's better than letting it tip at 5, but, and I won't, obviously, none of us will probably be here when we get to that point. But it should be a conversation that is had closer to the time when it does start to tip.
Yes, go ahead, Representative Obermuller.
Thank you, Mr. Chairman. Yeah, and I would add that, without the tip, the spending policy doesn't mean anything. So what you're really saying is, do we need spending policies? But you have to have the tip in order to control the spending policy. That's the whole point. Thank you.
Okay. Thank you. Is there anything else?
Well, just to follow up on this discussion, what's important about this is, I think, and why we're anxious to have open up the discussion to everyone to get support on this process, is because it just so happens that we're going to have enough money to actually implement this year. Just based upon, what our forecasts are, and that that will still leave roughly, maybe almost $300 million to $250 million for other projects outside our standard budget. So it's a unique opportunity. And then if you go back up and talk about the benefits of this, if you look at our opportunity loss, it was like in the last 5 years, it was $345 million.
So I'm looking at, when you say that, I'm looking at table 2, which says the opportunity cost of not doing the TR strategy, and it's 370 million.
That's the number I meant.
And so, that was my question, is it 345 or is it 370? If it was 345, I was trying to figure that one out.
No, it's 370. Sorry, I just did the wrong number.
And then the other question I'd have is when you go down to the second sub-punch line is on table 3. And in that one is just looking at the common school, the PMTF, and the state agency pool, and that one's 141.5 million. And I guess that one is just looking and saying is that one, as I understand it, that's just saying if we had invested the reserve accounts as they were, that was the opportunity cost?
Mr. Chairman, that table is if you had invested those reserve accounts in a total return strategy as well. And I believe next on the agenda is for our CIO to go over the TRR strategy.
Okay,
So
all right, go ahead.
I'm all done.
But just to make sure we're all.
Maybe you're all done. Go ahead.
No, this is
Senator
just a
Schwartz.
comment, but that 370 million is over 5 years.
Yes.
Yeah, I just want to make sure everybody gets
Okay.
that.
Okay, it's 70 million a year. Okay, yeah.
Which is chunky.
Well, it depends on who the chump is, I guess, but anyway, yeah. That's like 1 cent, that's about 1% sales tax, the net return to the state of
That's right.
1%, one penny additional sales tax. So, yeah, those pennies add up after a while. Go ahead, I think we're ready for you, Patrick. Yeah, we continue to,
Hand up on the screen.
did we have who was it?
Representative Harsh.
Representative Harshman, did you have a comment or a question?
I do not. I think is my hand up? It is not. No, I really appreciate it though. I'm looking forward to it. We have an incredible opportunity, so I'm excited to move this forward.
Okay, thank you. Thank you, Representative Harshman. Patrick, welcome.
Thank you, Mr. Chairman, members of the committee. It's Patrick Fleming. I'm CAO for the Treasurer's Office.
And we note that you are underpaid and underappreciated from our testimony this morning. So anyway, yeah.
Before I start, that's a great point. I do want to mention the issue of hiring people as well. So for the private equity, for Matt's position, we've received, I don't know how many, Don, how many applicants? 15, and 1 is worth a callback. We have the Kentucky Fried Chicken manager that can manage our private equity. He was happy to come over here for that, but other than that,
Finger looking good, baby.
there we go.
Okay.
I guess that means my application is rejected.
So before I start, the committee had asked if we could talk to the other interested parties and see what their views, just to make sure that everyone is on board. So before I start, I just want to let you know, and Tom Chapman, I don't know if he is on, but he will talk about the IFC's representation, but I also was able to speak to all of the SLIB members, and they said conceptually, it makes all the sense of the world. That in the world, that if you're trying to increase our returns and reduce the workload, they would be all for that. So big picture, that's really what we're talking about. So I don't know if Tom is on, but I don't want to speak.
Patrick, I'm on.
So I'll let Tom speak as far as the IFC's view of what we're trying to do.
Okay, Tom, you're on.
Great, thank you. Thank you, Mr. Chairman and members of the committee. Again, I'm Tom Chapman. I'm a member of the Investment Funds Committee. I'm going to be extremely brief. We at the IFC feel that, as Patrick mentioned in his presentation, most pensions, endowments, and sovereign funds really have one pool that they make investments on for a total rate of return. We have 15 pools, different pools, and 20 years ago we had 5. And this really does create a complexity element, frankly, that makes it way more difficult. And I'll say certainly makes it way more difficult than certainly the retirement system. And so we at the IFC, in trying to think about ways that we can try to achieve better returns, certainly this seems to be very low-hanging fruit. I will pass it back to Patrick, but certainly having talked with our other members of the Investment Funds Committee, we're all very supportive of this.
Okay, thank you, Tom. Patrick?
So, Mr. Chairman, we have gone over briefly this with other members and so forth, so I'll talk about it from the beginning, but I'll just go through it very quickly. So if you have questions on the overview, please let me know. So as we said, the number one objective, the top 3 objectives would be maximize returns and simplify the process. But to do so, we do need legislative support, as you know, from what we've talked about, for being able to increase the reserve accounts. As Tom just mentioned, this is not what everyone else, anyone we talk to, they always say, we're different, and we are different. This is not the way most other funds do. They have one very large fund and multiple accounts underneath it. That's the way that most of the funds work. On page 3, the current pool structure, that one is what I call the migraine-inducing chart. And it literally, every time I look at it, it does make me kind of go crazy. But that's the way our funds are set up right now. And it is a very complex structure and is not optimal. The committee had asked for percentages, so Katie had put through percentage allocation for each one of these funds. So to try and get it on one page and not too cumbersome, it's very small. Even with my 2.0 readers, I still can't read it. But
Can I borrow those from you? I'm in trouble reading.
Soon to be 2.25 or 2.5. And then on page 5 is the new pool structure. And this is really what it gets down to, is the 68 different accounts. Now this was, when we put it together, we said, when we look at it, we might have to tweak this, but in general, this is what we'd want to do. But as I mentioned before, there's some other areas, other funds that we need to look at and say, would it really make sense, for instance, for the LISRA, which has short, intermediate, and then longer duration, would it make sense for the LISRA's 3rd tier, the more total rate of return type of fund, to be put into the strategy that could be extremely illiquid? And so those are the things that we had talked about that we might need to tweak about it. And Josh is going to talk about the reserve accounts, and that whether or not it would be warranted for the reserve accounts in these as well, just because of the illiquid nature. And the committee had asked for RBK to run through the Monte Carlo simulations. And so we will talk about that for some of the changes that we would envision that would be needed, just tweaks to maximize the returns. So that on page 6, this is the point that I was referring to. If you look at the LISRA, 51% right now is a low duration, that first 500 million that was mandated to have in instant cash. And then you have 21% in core fixed income. That's kind of the next tier, a little bit still liquid, but a little bit higher yielding. And then that 28% would be this total rate of return strategy, which is really just the PMTF's current allocation. That's what we're talking about when we're talking about total rate of return. We're just replicating the most aggressive, highest potential yielding asset, which is the PMTF.
And Patrick, when you were looking at 6, is that kind of are those kind of the numbers and the allocations you use in computing the opportunity cost figures that we saw in the report from the working group?
Mr. Chairman, the difference on that, the opportunity cost of the bid offer spreads is much more important in not only this side, but then where it is invested. So the 51% very liquid, low bid offer spread, the 28% less liquid, but very difficult to sell. I mean, that could go up to 10%, for instance.
No, but what I'm asking, I probably didn't ask it very well. What I'm asking was when we saw the $370 million opportunity cost, and so in doing that, were you kind of using this trifurcation of LSRA, for example, and using was this kind of if in computing the opportunity loss, were you just using the 28% from the LSRA and computing that opportunity cost?
Oh, Mr. Chairman, I'm sorry, I didn't understand the question yet. What I was referring to before was just liquidity and bid offer spreads.
Right.
No, this would be absolutely the opportunity cost, which is in the SAP, the state agency pool, which is really just a cash surrogate, and where we are now. So as I had mentioned before to the subcommittee and so forth, that the last 5 years with very low rates, is that really appropriate to compare to where we are now? Is that an accurate assessment? And like, well, it's the best we have. But the bottom line on it is, any academic information you want, that cash will underperform a endowment-like return over time. And that's what we're talking about, cash
Right.
or an
No,
endowment-like
and,
return.
and we all understand that past performance is no indication of future performance. We all understand that. But I think what you're getting at is you took and said, if we had had this strategy in place 5 years ago, this is where we'd be versus where we actually ended up. And that's what that opportunity cost was. And this is, and so my question was, when we're using this pool valuation, if the TR strategy was used, I mean, we were doing the same, we were using, like, we didn't put all of the LSRA in and say if we invested all the LSRA that way, we'd be that much further ahead. We said we were investing 28% of the LSRA under that scenario in computing the opportunity costs. Is that correct?
Yeah, Mr. Chairman, if we just go to the page 7, and we'll just go over it, but
Okay.
that is correct. So what we're looking at is, let's just use Common School because that's the big one. So the Common School is invested in what's called an income-focused strategy because of the 5% mandatory spend. So when we looked at it, we said, all right, the reserve account is not large enough to sustain a series of losses. To hit that 5% return, we need to have more of an income focus. And just as we said, cash would underperform, we know that more fixed income will underperform over longer periods of time. And so that was the trade-off that we had to do to make sure that we would fulfill that 5% spend. So both the Common School and higher education, what is invested in what we call an income focus. So on each one of these strategies, you can look at Common School, which is the big one, and then higher ed was the income focus. And you can see the difference in the returns, 313 million, just because it's a lower return, which was approximately 5.5% for Common School versus 6.7% for the PMTF. And if you just take the state agency pool, which was, I believe, 1.2%, that difference between the 5.5 and the 6.7 equates to that number annualized over the last 5 years. If you look at the amount invested in year one and compound that return over 5 years, year one compounded, year two, year three, year four, year five. That's how the calculation was done.
Thank you.
So would it be 370 over the next 5? Who knows? But we know for a fact that cash is not the best rate of return for the various funds.
Yes, go ahead, Representative Shores.
Thank you. So Patrick, I'm looking, I don't even know what, page 5, and I'm comparing the allocation of the LISRA versus workers' comp. And they're, in my mind, I assume they have similar functions, but they're invested differently. So could you enlighten me on the difference between low duration versus core fixed versus long duration?
Mr. Chairman, Representative Schwartz, absolutely. The difference between the two, the LISRA has 3 different buckets depending upon liquidity, what was deemed, how much would the legislature need in a Cat 5 type of hurricane. So we thought, well, 500 million mandatory in a very bad year to take care of all the spending. So that part is in the very liquid fixed income. Then to get something a little bit better yielding, we put the rest of it into the next tier, into a core fixed income, which is a higher duration, which would be about a 6-year duration, slightly more risk, but still extremely liquid. And then the third tier is let's try and get a little bit higher return on this fund. And that's really what 28% is really for equities and so forth. On a longer term basis, we could get a higher return. Workers' compensation, conversely, is a liability-driven investment. It's called LDI. And that is because workers' compensation's duration is last year was about 11.5. This year it's 10.5 years. So their liability is 10.5. So what you want to do is tenor match those assets and liabilities. And so what we did before, we had it in a very short-term fund. That didn't make any sense. So what we did is we said, okay, we want to offset those liabilities with an asset of a 10.5 year. And that's where, if you look at the liability, we can see the actual investments back on, what was that page?
Okay.
Page 6, I'm sorry, forward on page 6. Workers' comp, so 26% is in core fixed income and long duration fixed income. So what we did on that one, you have corporates and treasuries, which offset that liability. So if you look at it, you said, okay, if everything goes through, we have the liability, the asset to offset that liability. Anything that was left, basically overfunding amount, then let's put that into something that would earn a higher yield. So similar to that, to the LISRA, that portion of workers' comp would also be in that area.
Yes, go ahead.
And this may not be a question for you, so I'm looking at the balance, and it's up from November 1820, which is in the fiscal data book, to, what is this, May 31st, it's up about 100 million. But that just stays in the account. We can't, that's just offsetting a liability. And we just keep increasing that, knowing that it has only one purpose? There's nothing we can do with that money except workers' comp.
And the answer, so what will happen with that is it'll affect the premium rates for employers, because you back into the premium rates through the actuarial study, and I don't know that Patrick probably knows that, but I'd call him before he had to phone a friend.
Thank you, Chairman, for reminding me of something I actually are used to now.
So, Mr. Chairman, Representative, correct. Realizing that part of the fixed income structure is the most volatile. So if you look at the returns, you'll see that is the area that got hit the hardest. So we know the movement in that is dramatic. Today in the UK, long rates went up over 25% in one day. That's the volatility that you're dealing with in that long end. I mean, in '87, the equity market went down 23 and it was a crash. Today, just like, no. But those are the things so you have to offset the liability, the LDI, liability-driven investment, and then anything else is kind of what we're working with that excess above return. And every year we get a study, and we work with RBK to reassess those asset class distributions. So the other slides before we hit the reserve account is just going through the asset allocations amongst the various funds. If you had any interest to say, well, what are we really referring to in some of these? Now, where the rubber meets the road is really the reserve accounts. And why wouldn't we do this before is because we didn't have the funding to properly match a series of downturns. And so that is why we weren't able to, and originally why we moved Common School and so forth into this, is because we were concerned if there was a sell-off, we wouldn't be able to meet that 5% mandatory spend. So with the reserve accounts, as Polly has mentioned in going through it, if we're able to increase those reserve accounts to allow us to invest those excess reserves into another investment, then that would be where we would get the added benefit. Now, I don't want to take away Josh's thunder when he comes through, but going through the studies and looking at what would happen in, for instance, 3 1-in-100-year events in a row. Is it likely? No, but could it happen? Absolutely. 29. You just see it periodically. Just what we're having now with what's happening in the sell-off in both equities and fixed income. Those are the type of events that would be very detrimental to the reserve account. So what we looked at is what happened, and we talked about this in the last meeting, that the liquidity that you would need for those reserve accounts, if it's invested into the same thing as the PMTF, is you would liquidate the liquid assets, and then you would be left with the illiquid assets. And so that would not be enough to support it. And so Josh is going to go through later on, and you'll see this, but his solution, RBK solution, is that you would, in these reserve accounts, you would just put it into a very liquid, like 70-30 or 50-50, 70% equities, 30% bonds, 50% equities, 50% bonds, and have the reserve accounts in something that would be more liquid as opposed to the total return. If you actually look historically how it's done very well. A 60-40 portfolio over the last 10 years has been the best performing portfolio over the last 100 years. So it's kind of again, data difference of what it's been, but still it would be a very easy liquid way to make sure that those reserve accounts would have the ability to be used when needed. And so that's the part where we talked about before, for instance, the LISRA, that third tier of the LISRA, that would be an account, I would say, that would be also up for being invested into a liquid type of total return strategy. So we'll go into much more detail on it, but I just wanted to preface the conversation before, so when we're looking at these numbers, and I just did a rough and dirty calculation on page 11. So when we're looking at this, Mr. Chairman, you asked the question, if the reserve accounts were invested, what would happen? So a 50-50 portfolio, you see the 5-year annualized at 5.5, a 50-50 would have been 5.59 return. And a 70-30 would have been a 7.22. So it's really very close to the total return strategy, what we're looking at, but it's much more liquid. And I would argue the reason that you wouldn't do that with the other fund is US equities just had, 1-in-100-year type of moves over this. It was a outsized move, and that you wouldn't want in all of the funds, such a small, you would want a diversified, well thought out portfolio that would have all of these different, if you look at the liquidity and volatility, you're much better off in a diversified fund, which we have. That's the point.
And so looking at page 11, so if we make this move, and as part of this, we expand, and so if our reserve accounts have been able to be invested in the way that the proposal looks, it would be another $141 million that we don't have, that we otherwise would have been available. So is the other part of the punchline, do you add the 370 and this 141 together? Is that the total opportunity cost for not having been engaged in this? Is that how we should understand?
Yes,
this?
Mr. Chairman. It's just that these funds, also reserve accounts, as you know, are invested in state agency pools. So you have, what would the ability for those accounts to be invested? So the other the 370 million, that was the total funds. We would gain 370. Here would be the reserve accounts, how much more we'd have. And so the numbers that I ran, the difference between these various would be between +5 and -13 million off of that 141. But again, I feel very confident that these types of returns would beat any cash type of return that we have in the SAP. So whether you use the total return for a reserve account or 50-50, 70-30 is really insignificant and
The question is, I think, Patrick, when we explain this on the floor, do we do 370 plus 141? So our total savings, if we do everything as recommended, over the past 5 years is closer to a little over 500 million.
Mr. Chairman, Representative Nicholas, that is correct, but instead of saying 141, what I would like to do is to go over Josh's presentation, and you can look at that, and then we can come through and model what that actual 50-50 or 70-30 portfolio would have been.
Yeah,
but it's going to be approximately 130 to 145.
You're way down in the weeds, and we're way back at 30,000 feet.
I'm sorry, Mr.
So
Chairman.
all we're trying to do is for folks that would, if you present this on the floor and you're introducing this, to me, the punchline is page 11 and page, whatever the other page was, page 10, was it page 10? But anyway, you add those two together, and isn't that the opportunity cost
That is
by
correct, Mr.
not
Chairman.
being engaged in a TRR
That is correct.
portfolio? That's the total opportunity cost. So 370 plus this 141.
That is correct.
Okay. Now go ahead and go back to the weeds. We're with you.
So the other part of it that the subcommittee had asked us to do is would be to look at other participants. For instance, Pool A. Would they want to have their funds, all the funds that they have, in a less liquid type of investment? So what we wanted to do is to see what was the committee's pleasure. If we were moving forward with a bill and this is what you wanted us to do, then we would be able to reach out to the participants and say, okay, this is a less liquid investment. Do you want to have 100% in there? And if not, they could have 50% in here and the rest in cash, or any variation that they would want to do. But what we would do is then go to the various participants and make sure that they felt comfortable with this strategy. But before we went to the next step, we wanted to see where we would be after today's meeting. The last part would be really the benefits, unless you want me to go through all of the other various slides and so forth. It's somewhat de minimis.
Yeah, I mean, you're just going through the individual accounts and so.
Exactly. And then would be the benefits that Katie can comment on.
You're on page 20?
I am on page 20, that is
Okay.
correct.
Katie, I think Katie's is less accounting, more simplified accounting, good. That's your message, I think, isn't it?
Hi, Mr. Chairman. Yes, Katie Smith, Administrator of Financial Accounting for the State Treasurer's Office. It's pretty simple for me. The less pools, the easier it is to account. The less I have to split off, the easier it is for my staff. So it's kind of a no-brainer. It also simplifies and helps us become somewhat of a comparable to other sovereign wealth funds because we would be investing in pooled by strategy instead of by fund. And so all of the customizations and things that we talk about were unique. All of kind of the dirty words that we hear now when we reach out to other states and other sovereign wealth funds, it gets eliminated. We can now have those conversations about what's happening in the market and different accounting strategies and things like that. When you're so unique, nobody can really be compared. I get laughed at by some other states. They don't know, like, good luck, let me know how that goes. So it eliminates that.
So, and if I can just interrupt, the other thing, I mean, and the sub-fund accounting becomes very simple because it's just simply a pure proration because everything's invested the same way. Is that correct?
Mr. Chairman, absolutely. So instead of having that huge grid that you saw with all the percentages, it's really streamlined into one column because it's 100%.
If Hathaway's 5%, then whatever, it's 5% of whatever the value, 5% of the gain or loss.
Absolutely, Mr. Chairman. So how we distribute now is a proportional share. So it's the average cash balance sitting in that pool for that month when we distribute earnings. nothing would change with that. It would be the same thing, because all of those would be then commingled into one strategy pooled investment. It also, we've been pushing towards a more quarterly cadence with our reporting and our distributions. That has been a very complex endeavor, going with how we're currently structured. Going to a simpler structure makes that a little bit easier as well. And so we have another slide in here regarding the monthly to quarterly distributions, kind of the plan of attack, what we could do. Obviously, we need to get through the audit first.
Katie, before
yes.
you go there, let me just,
Sure.
and I think I'm just trying to illustrate this. I'm thinking of how we, again, explaining these types of benefits to people on the floor. And the way, because right now, the way we do it now, it's almost the inverse of what we're talking about.
Yes,
Which
Mr.
is,
Chairman.
we have, pick somebody, we'll say State Street. You got State Street, and State Street has so much of the PMTF and so much of this and so much of that. And so anytime they make a transaction, you have to figure out their proportionate shares for State Street and allocate it back to those funds. And you got to do that for each of the 70 or so fund advisors we've got out there. You've got to do each one of those individually and separately now. If we did this, then State Street, it's 5% of the PMTF, 5%. It's just a straight proration based upon what those balances were when we start with, that you started with initially. It's that simple,
Mr.
isn't it?
Chairman, absolutely, yes. So State Street, right, they're going to get the same amount of money, but it's less split off for us. It's not splitting it up against all of those pots, or having all of these different pots feed into it. It's one big pot, and then it's a prorated balance proportion. So no, it makes it much easier, far simpler to be able to account for it and make sure that the constituents, the stakeholders, are getting their cut of the pie.
All right, thank you.
And then again, Mr. Chairman, walking through the monthly to quarterly distributions primarily, but also this would be a new cadence for reporting as well. So definitely want to go that route. It'll be more streamlined for us, time efficiencies for sure. The more often you do it, the more room for error. And it's a time suck. It takes us at least 2 to 3 weeks a month just to get through the distribution process, start to finish. With bringbacks and actually getting it out to the stakeholders. So when we do this on a quarterly basis, it'll make it a lot easier. Not to mention, the longer the money is sitting with the manager, the longer they can earn off of it. So if we're not pulling it back each month, that makes it a lot more advantageous for returns. So the plan of attack would be obviously get through the audit, but then I have component units that I have to think about. Component units have different fiscal year ends that I need to be considerate of. So when they're asking for their own ACFR reporting requirements, I need to ensure that I know the right cadence of quarterly distributions that will also be accommodating to their own fiscal year end, so I can ensure we can report timely for their ACFRs. And then statute assessments, obviously looking at what's out there, what is being required, all of those things. And then hopefully by March, we could set a quarterly cadence, the schedule, prepare and kind of get through all of our process changes, things like that in the new system, all of our spreadsheets that hopefully will be eliminated soon, and then notify the stakeholders and finalize the process so that we could eventually go live with this new quarterly cadence along with the total return strategy structure, July 1st of 2023.
Katie and or Don Richards, if you're listening, I'm curious how quarterly distributions may impact the need for continued borrowing in terms for cash flow purposes for all entities. Particularly, well, the schools is a good example because they have to borrow regularly because of when revenues are received. So,
Mr. Chairman,
so if we need to take that into consideration.
Co-chair, absolutely. Mr. Chairman and Co-chair, that is exactly part of the assessment process. I need to look at the loans, talking to Department of Education. Also the boards, there's boards out there that are very small. I mean, they don't have a lot of cash flow, so they are dependent on those distributions. How is that going to affect them as well? Can they make the bills in 3 months, or are they truly looking for that investment income? So you're 100% right. That's all part of that assessment phase in hopes that we could come up with a solution so that we can still move forward with the quarterly distribution cadence.
Mr. Chairman, Mr. Co-Chair, one other comment on that, as Katie alluded to about the managers not having the investment. So when we speak to our managers, no one else does these monthly drawbacks. So a lot of times they'll just sit there and say, well, we know Wyoming's going to pull back money, so we don't want to put it in. And so they'll just say, well, it's, around $2 million a month or whatever. So it just sits there for that 2-month period, earning fees, whatever, but it's not invested in the market. So, and that's across all of our accounts that have income. So that's another suboptimal way that our managers kind of just have the cash available for the state of Wyoming because of the way we do it. So the way they do it now, quarterly, everyone does it quarterly. We're doing our quarterly rebalancing now. That would be very, very easy for our managers.
So you don't think we can be trendsetters? You think we need to reverse that?
No, Mr. Chairman.
Okay, thank you. And then that's what the component unit and statute assessment is to look all that and then sync all this stuff up. So again, we can, which you have to do if we're all going to be one fund, total return fund. Okay. All right. Any other questions? All right, continue.
I'm actually finished, Mr. Chairman, if there's no other questions for me.
All right, thank you, Katie.
Mr. Chairman,
We do have a question. Go ahead, Mr. Vice President.
and just a little bit of deviation, we've looked at all of the state's account, but we have had no discussion with the WyoStar, which is most of our local governments, school districts, counties, special districts. And I have no idea what it takes, but when I look at that chart on 5, it's all invested in cash. Is there any opportunity that the treasurer's office could, there's probably hundreds of different entities that have money in WyoStar, but is that something that we should look at going forward? And what I don't want to do is confuse bringing in all of that at this point in time, but what I'd like to do is say, look, if we get this done at the legislative level for the state's account, but then we go back and look at bringing, because it's about $1.1 billion out there. And I just come back to the local government distributions, the money that we put out, if we can help them get a higher rate of return on their investments, that alleviates a burden on the state's budget also. And so, Patrick, what's your thoughts on WyoStar?
Mr. Chairman, Senator, it's a great point, and that is something that had started with Treasurer Gordon at the time, and now is continuing on with Treasurer Meyer, and what Treasurer Meyer is working on and has been working. In fact, I believe it is tomorrow that he is giving a presentation to these entities. So what we did, let's go back. WyoStar 1 is just a money market fund, and so they had the ability to get institutionally managed 6 basis point management fees. The next iteration was WyoStar 2, which now allowed them to go into corporate bonds to get a little bit better return into a corporate bond structure. And now the amendment that is being put forth at this time, is it Amendment A as well?
Yeah.
Yes, and this would be for the equity investment. So this would be WyoStar 3 for equities. So the funds that would be able to withstand the volatility would then be able to invest into WyoStar 3, which would just be an ETF type of investment, which is 2 to 3 basis points. We would still institutionally lower fees because of us. We would then be able to pass on those lower fees, but then they would be able to have that equity type of exposure as well. And if you're really looking at 70-30, 60-40, what have you, if you had all 3 of those, they would be able to really dictate whatever they want. Do they want a 70-30? Do they want a 70-20-10?
Set their own horizon based on their risk tolerance and
Absolutely.
potential return.
So they could look at it and dictate what they want with their asset allocation. How much risk do they want? And so they would just say, okay, let's put in 70, 60, 50, 40, whatever they could. And that would fill all of the buckets to allow them for funds that they don't need right away and that can withstand the volatility. The downside to that is they have to understand the loss
there's a
potential.
risk.
And that's what Treasurer Meyer is going to tell them tomorrow about. It's not a free lunch.
All right, thank you.
Go ahead.
Thank you, Mr. Chairman. Patrick, how do you think about the difference between the 5 times and the 7 times on the page 20 that we were looking at? The implications of that difference. I mean, why would we choose one or over the other?
Mr. Chairman, Representative, that I think will be a clearer picture when Josh, who is going to go after the deputy about what's happening. But the one thing that, from our perspective, which would be interesting, and as Representative Schwartz commented, is if we started at a 5 and then were able to build that up with excess returns to a 7 or what have you before it tipped, that to me is the most important aspect of something. If you were able to start at whatever you deem is appropriate and then build that up until you tipped at some other level. And I think it's going to be much more apparent when you see the numbers of whether you need a 5 or a 7 when Josh does his presentation.
Okay. Anything else? All right, so I think we're to you, Don. And you gave us a little bit of a preview this morning, so anyway.
Yes, Mr. Chairman, thank you. Don Williams, Deputy State Treasurer. If you believe it would be more, if it would make more sense to go to Josh and talk about the 5-7, I'm certainly willing to forgo my turn. I'm here to talk to you about the timeline that was requested by the subcommittee. We put our heads together at the Treasurer's Office and tried to come up with just a roadmap of how we would proceed if, and it starts really with today, with getting the go-ahead from the committee for the total return strategy and so I'll just jump right in. We have secured the support of the SLIB and Investment Funds Committee. They're on board because, like Patrick said, it's kind of when we tell them it makes it less complicated and we get more returns, it's a pretty easy sell. But then we come in with the details, of course, in the timeline and how we want to effectuate that.
Mr. Chairman, real quick, when you say the SLIB and the IFC are on board, is this with the 5 or the 7%? Or the 5 times or the 7 times?
Mr. Chairman, I don't believe that the determination that they don't have an opinion one way or the other on the 5 or the 7.
Just with the concept.
The concept of
Going
total
in this
return.
direction. All right, thank you.
Yes, Mr. Chairman, thank you, Senator. So we are reporting to you today. We're having RVK speak to you about the 5 and the 7% spending policy and reserve account appropriation recommendations. And so as of today, if we secure your support today, then we'll move on with those meetings with our Pool A recipients and any other stakeholder that we believe that would be affected by the change, possibly UW, Community College Commission, workers' comp, all of the folks that have funds with us in the larger pools. We want to develop a guide sheet, and then we've outlined some of the things that we would like to include in our guide sheet as we prepare our presentation and explanation to these stakeholders. We are, of course, this is our brainstorm, and so if we miss something, we're appreciative of any additions or even eliminations if you think we're going wrong. We'd like to have those meetings next week. We decided next week or the following week, we decided that we'd like to try to have 2 meetings and invite folks depending on their availability and just have a kind of a larger meeting rather than one-on-one meetings. That way the groups are hearing the same information at the same time. And so then again, we'd like to include those stakeholders and review these risks. And as the chairman aptly pointed out, we all understand that prior performance is not an indication of future performance. However, that's not always a given that we feel like that needs reiteration. And so that'll be one of the main focuses of our conversation with them. One of the things we run into, just take as an aside with our local government entities as they're contemplating this amendment, we've had a lot of questions about, can we make our own choices? Can we choose our own investments? Can we if we don't like a company that left our county, can we, exclude them from being a part, being invested in by the program? And so there is a lot of education we're learning that needs to be done, and Treasurer Meyer will start that tomorrow with at Waco at the convention for those local entities, to try to keep helping them to understand what this means. Because what we find with Wildstar is, with the 1 and 2 accounts, they're often used as checking accounts and not investment accounts. And so we have there's a lot of education that needs to go through, that we need to start imparting, continue to impart to our local government partners, so that they're fully aware of the meaning of this, and we extend that to our Pool A participants as well. So those are some of the things that we'd like to share with them and make sure they're aware of. In November, we'll come back to you and we'll tell you what happened, and we'll also work, and we've talked with our LSO colleagues, invite those stakeholders to come and testify. Maybe they don't want to do it, maybe they don't like it, maybe they love it. That's their opportunity to come and tell you what they think. Ideally, you would pass the spending policy bill and the reserve account appropriations. And then you have also asked us to prepare some talking points for the committee members as you go and communicate this concept to your colleagues. And so we would work with you to prepare those talking points. I missed a huge important thing in my timeline in the memo I provided to you, and that is that big gap of time between November and March, where you guys do all the work, where you take these bills to the legislature and you get them passed, and then the governor signs them. Those are the most critical pieces of the pie that I did not really put on my list. So I wanted to make sure I mentioned that. So if that all happens, then and we're all presuming, of course, that we're moving on the path, in March, we would present the asset allocation targets to the IFC. We have an annual meeting, asset allocation meeting. And then we would also start at the same time with Katie's accounting team, her group, and working with our vendor, discussing how the reporting will change in our new system. And then April and May, we would go to SLIB. We have a working session with them after the IFC asset allocation meeting, where we talk to them about what the IFC recommends. And then we would modify our investment policy statement according to their recommendation at the working group. And then we present it to them in June at their formal meeting for passage and approval. And should that all happen, we would be positioned to implement the new strategy as of July 1st.
Okay, go ahead. Representative Schwartz.
Right.
Yeah, I'm
Easy
amazed
peasy.
how simple this is going to be. And thank you for making it that way. With Pool A, so you're going to meet with all of the shareholders. How many options are you going to present to them?
Mr. Chairman, Representative Schwartz, 1.
You're either in or you're out.
No, yeah, that's right. Mr. Chairman, yeah, that's in or it's out. We really, the idea is to reduce the complication and not to increase it. And the more options we would offer, and we don't want to create a cafeteria plan where this program can choose this and this program chooses this. That would not therefore create less complication.
Okay, thank you. Anything else for Dawn? Anything else for Dawn? All right, thank you, Dawn.
Thank you.
So I think next we've got Josh. Now we're up to Josh. Josh, go ahead.
Great, thanks, Mr. Chairman. I just wanted to make sure, do you all have our presentation that we prepared on this? Okay.
Yes,
So we were asked,
it's been distributed, and I think there's also hard copies here if somebody needs one.
excellent, thank you. So we were asked on, and I'm going to start on page 2 here. We were asked to provide some analysis on these 2 different levels that have been discussed. 5 times and 7 times in terms of reserve fund levels. And I think the question that was asked a little bit ago was the right question in terms of what are the implications of 5 times and 7 times. And I'll give you the kind of bottom line punchline, for at least from our perspective on this to start with, which is either is fine, but it does have implications for the level of risk that's appropriate for the reserve fund portfolio. And if you think about where you're at today with these reserve funds, you have, I believe you're running these at something like 1.5x, and that is a relatively small reserve relative to the potential draws or demands that could be placed on the reserves in any one year. And as an extension of that, it has implications for risk. And that's why it's run today in the state agency pool at a very low level of risk. And so part of what we were trying to do with this was to help illustrate what levels of risk might be appropriate at 5x or 7x. And there's an opportunity cost with the lower the reserve, the less risk that's appropriate, because there's a greater percentage that might be demanded in any one year, and that has an opportunity cost. But the flip side of that is to have a larger reserve, it takes more money up front. So basically, it takes money to make money. It's kind of the answer here, but we'll try to frame this up a little better than that for you. Just to set the stage a little bit, some of this is background, some of this is assumptions that we made to simplify the modeling. But the setup in terms of what we're assuming for this is, number one, this allows all of the permanent funds, with the exception of workers' comp, to adopt the asset allocation policy that's currently in place for the long-term total return permanent funds, such as the Permanent Mineral Trust Fund. We assume that all the existing spending policies and spending mechanisms remain as they are, so nothing changes as it relates to income is what's distributed, and all income is distributed from the corpus, and only net cumulative capital gains are distributed. We are assuming that this increase in reserve fund size is what allows for a larger source of potential funding in years where portfolio level income on the corpus falls short of the spending policy amount, and that by having a larger reserve, you're able to actually take more investment risk with those reserves. In talking to Patrick, we understand that the reserve funds would not be able to be commingled in the same pool as the corpus. They do need to remain in physically separate accounts, and each fund will need its own separate reserve account. That combined with the fact that we're talking about, if you're talking about a 5x potential annual need, or 7x, that's either 20 or 14% of the portfolio that could be demanded in any one year. So that has implications for liquidity. So we would assume that with that profile, you should be thinking liquid assets, either exclusively or almost exclusively for the reserve funds. So for purposes of this study, what we've done is we've just picked sort of two points that are illustrative, and Patrick mentioned this earlier. One of them is 70-30, one of them is 50-50, and by that we mean 70% global equities, so not just US equities, but global equities, and 30% investment grade US fixed income, or in the 50-50 scenario, a 50-50 blend of those. Now, really important to note here that those are not portfolio recommendations. Those are illustrative examples to help make a point about what risk level is appropriate. And you do this, you know, for example, the 70-30, for example, is actually how you express maximum risk in the statutes for the permanent funds. So it's very similar to how you've expressed that in statute before. And what we would actually envision is that we would actually want to do some asset allocation analysis and work with the IFC and the Treasurer's Office and the SLIB to develop liquid portfolios for these reserves with the risk guidelines that are appropriate for the size of the reserves. So that's, even though I'm using 70-30 and 50-50, please keep in mind that's intended to be illustrative of a risk profile more so than it is a portfolio recommendation. If we go to the next page, in terms of just how did we go about stress testing this? Well, the big unknown, there's two unknowns that we need to try to examine here. One is investment markets, and the other is how much is needed, how much needs to be drawn down over in any 1 year from the reserves. So for the first, the investment uncertainty, we've actually used some pretty sophisticated stochastic modeling of a wide range of potential investment outcomes for these two portfolios. I'll explain that a little bit more in a moment. For the draws, we've actually come up with a couple of different scenarios. This is more of a deterministic, just imagining, okay, what would be a bad scenario for draws? And as Patrick noted earlier, like from our perspective, like the worst thing from a cash flow perspective that could happen to these reserve portfolios is you need to take the full amount out for several years in a row right at the start. And that's one of the scenarios that we'll focus on. So it's really kind of bringing these two things together, or the range of investment outcomes, a range of cash flow scenarios, and really asking ourselves, you know, what does this look like when both are bad? When investment markets are bad and you have outsized needs to draw on the funds. And so that's some of the setup for how we went about this. Just some additional notes and assumptions here. When we say 5x or 7x in this study, we are assuming that that means 5x or 5 times the amount that might be needed to be drawn from the reserves in any 1 year. So we heard earlier that for example, there's the spending policy amount, but you may also be assuming that there's a certain base level of natural income off the corpus that's always going to be there. Generally, that's never been below 2%. We're not trying to introduce that complexity into our modeling here. So but just to keep it simple, you know, if you assume a 5% distribution and you know you're going to have at least 2% from income, you may be focused on that 3% as the potential draw in any 1 year. But when we say 5x, we mean 5x whatever that potential draw on the reserves could be in any 1 year. And that allows us to simplify the modeling of this quite a bit, because what we've done here is we basically have just assumed that 1 year of potential need starts at $20. And so 5x, if you've got 5x in reserve and your potential draw in year 1 is $20, that means that you're starting with a reserve fund balance of $100. Or if you've got 7x, you're starting with $140. And we do assume that 20 grows at a rate of assumed inflation. It's not static, it will increase over time. The variables that will change that are more complex than I think is worth trying to model here. But we do assume that it grows to at least at a rate of inflation. We're also assuming, we're not assuming any additional contributions into the reserves. And we are assuming that depending on which one we're talking about, if 5x or 7x, that once you get to 2 years above that you sweep out the excess and that tips back to corpus. So if it's the 5x model, we assume that anything above 7x gets swept out, and if it's the 7x model, anything above 9x gets swept back to corpus. We also assume that anything in the reserves are not available for appropriation. So that's the background and the setup. Pause there, see if there's any questions so far.
All right, thanks, Josh. Go ahead,
Yeah.
Mr. Vice President.
Josh, I got a question. So when we look at this, and I think you mentioned it, but there's nothing in your model funding here. If we have 5X or 7X, in your analysis, you're looking at the exact same asset allocation, correct? As far as generating those returns. So asset allocation doesn't change regardless of whether it's 5X or 7X.
Mr. Chairman, Senator Hicks, yeah, for purposes of this analysis, we're not assuming that it's dynamic. So we're not assuming that as it goes, maybe it grows from 5 to 7. We're assuming that you have a policy in place, and we looked at 2 different policies for this, 50-50 and 70-30. Again,
Yeah,
it would
for
be something
comparative-
different than those, but it's not dynamic. We assume it's a constant policy.
Yeah, so for comparative purposes, that works well. But let me ask a question based on your expertise, and I'd ask Patrick this too. If you have 7X, doesn't that allow you to then assume some potential more risk that also has the upside of potential greater returns, knowing that you have 7 versus 5?
Mr. Chairman, Senator Hicks, you are jumping to the answer. I think that'll become clear as we go through this. Yeah, that's exactly
We have
right.
a question. He read ahead. He went to the last page. Anyway,
No, I'm just trying to get to say,
Representative Larson, go ahead.
all right, go ahead.
Thank you,
I've
Mr.
not
Chairman.
read
So,
this.
and I don't know, this may be to Patrick, but I heard.
I'm already there.
I heard you say that we need to keep the reserve funds segregated or separate. And I'm curious, is there statutory or constitutional or some kind of barrier that prevents us from having those reserve accounts be combined, but know that what's in them? Why do we have to have separate reserve accounts?
Mr. Chairman, Representative, I believe it's just from the ease of accounting processes, but I double check with Katie and Don. The reserve account segregation is just much easier to segregate them from accounting, or is there any legislative rules? No, to keep them from being combined into one.
So following up on that, is there any reason why you can't treat the reserve accounts exactly the same, which is all the values are X and that's a certain percentage of all that? Or I guess the difficulty with that is anyway, that's the first question is, can't you just kind of have the same concept? You have a single fund for your reserve accounts, but each reserve account constitutes a certain percentage of that reserve account. Now you're gonna have to adjust from time to time because not all draws will be equal, but I think that's the question that Representative Larson's trying to get at.
Mr. Chairman, I think if I heard you correctly, having all of the reserve accounts money in one fund and then it being proportionally shared out based off of whatever spending policy ratio you wanted?
I think that's the question.
Can that happen? From my perspective, I mean, I see no issue in that, accounting wise. Is that?
Well, yeah, and I was just, because I heard in the presentation that it referred that you indicated they had to be separate, but yet we're moving forward with this concept that our permanent fund, that we combine these and make life easier. And I'm just kind of wondering, is there an advantage to having just one fund with all the reserve amounts combined, or does?
Well, and Mr. Chairman and Representative Larson, if we're talking about potentially a separate pool to have them all in, I think I would vote no for that. I don't want them in a separate pool for accounting purposes, but having all of the reserve accounts sitting in the total return pool, I see no issue with. I guess fund and pool sometimes become interchangeable, so I don't know if we're talking apples to apples.
Well, and I think the question and what it gets down to, I mean, ultimately, we're just trying to understand on the total return and the one fund process. I think the question is are the reserve accounts, except for the cash requirements as you determine for each account, which is different, that's out. Take those aside and take those out. But the rest of those, aren't they invested just as a part of the total return fund? I think that's real, that gets to the crux of what Representative Larson's trying to ask.
Yes, Mr. Chairman, so the process would be all of those reserve accounts would have the exact same investments. It's just how you account for them. And when we originally looked at it, we said from counting ease, if you had each one of them, but that's Katie's decision. It would be easy for us. It's whether you want
Absolutely. So,
PMTF reserve account, common school reserve account, higher education, and Cathaway, if each one of them would be a separate, even though they have the exact same asset allocation.
Yeah, they're just a fund share. They're a share of the fund.
Mr. Chairman, absolutely, and Representative Larson, apologize for that. If say the funds are structured exactly the way they are, we just move them into the total return pool. They're no longer an SAP. They're just moved to the. Absolutely, that can happen. If you wanted to combine all of them into one fund as a total reserve fund, you could do that as well. Obviously, the less funds, the less proportional share. So I'm always going to vote towards that, but totally understand making sure that you have common school as one fund still, the way that it is now, PMTF having its own reserve. That can happen easily. We just transferred the funds from SAP participation to the total return pool participation.
Did you have a follow-up, Representative Larson?
No, thanks for the help, Mr. Chairman. I just think I overthought it. I think that they're doing exactly what we're talking about.
And I wanted to circle back on that while you're there, Katie, and in some respects, it occurs to me that that's also one of the reasons to move towards quarterly distributions is because in allocating among the single fund, particularly with reserve accounts, that if you're making quarterly distributions from reserve accounts to meet issues with respect to spending policy, that you may have to then make those adjustments, and then that will affect that particular reserve account's proportionality to the total fund. And so you're going to have to make those adjustments at some, periodically, and certainly quarterly it'd be a lot easier than having to do it monthly.
Mr. Chairman, absolutely.
Yeah. Go ahead, Representative Obermueller.
Thank you, Mr. Chairman. On the reserve funding model, as you go down through that, one of the statements on there is reserve assets should remain in liquid assets only as they may be needed to fund the spending policy amount. How do you think about that sentence? To me, it just goes counter to what we're talking about. I mean, aren't we building these 5 and 7 so that we can invest in a bigger pool? And not that they're not separately in a liquid form like this would suggest?
Mr. Chairman, Representative Obermueller, what we're referring to on the liquidity component of it would be really like private markets that is in the PMTF right now that has a 12-year life. Those would be excluded. So as Josh mentioned, it would be liquid assets, for instance, ETFs, any type of liquid investment. Once you get into the private markets, then you're locked in to 5, 7, 10, 12-year terms. And so that's what he was referring to when they went through the analysis. They showed that because of that liquidity, if there was a big drawdown, you would run into having a larger proportion of illiquids. And so that's what he's referring to, is just having liquid assets, so you can have equities that you could sell, but it's the private markets that are the problem. Anything that has a hedge funds that could be 2 to 3 years, those would be excluded.
I'll follow up, Mr. Chairman. So the idea of having one investment strategy for all these funds just isn't realistic. You would have to segregate to have some funds that are allocated differently than others.
Mr. Chairman, Representative, that is correct. Just like the LISRA, where we had that split out, we'd still need to split those out. We can't take the LISRA and put it into the total fund. So there's certain idiosyncratic reasons that some of the funds, workers' compensation, as Representative Schwartz said, cannot be in that. So we would have to segregate certain funds just because of those reasons. And, one of the biggest things would be the liquidity reason for, the LISRA or the reserve accounts.
So follow up, Mr. Chairman, on the,
Can I interrupt? Because I just want to clarify a point that you just said that came up in your question. If I can I do that? And so you said that the LISRA would, but it's really, you've got the LISRA bifurcated or trifurcated. So don't you have 28% of LISRA is vested is invested just like the PMTF. So it's not the entire reserve fund, but actually the LISRA has these three subdivisions inside LISRA, some of which are are way differently invested than other parts where, for example, where you need the liquidity. We're still there, right? We haven't changed that, correct?
Mr. Chairman, that is correct. But the 28% we did keep that out of the privates as well. So when we did that part of it, we just wanted to make sure. So we didn't put those into very illiquid assets.
Okay, so go ahead, Representative Obermuller.
no, I think you kind of got at what I was going to say.
Representative Schwartz.
So I want thank you, Mr. Chairman, the opportunity to display my ignorance about workers' comp again. So I think you mentioned, or Katie mentioned, that a lot of other states only have one fund. But how do they deal with workers' comp then? Which clearly, because I assume all 50 states have.
No. In fact, almost no other states have.
Oh, see, I
workers' comp
love
funds.
displaying my ignorance. This is,
Well, we couldn't get any workers' comp companies to come to Wyoming, so we do it ourselves. So, so anyway, go ahead, Patrick.
No, Mr. Chairman, Representative Schwartz, that is a very good question, because when you talk about CalPERS or CalSTRS that has 300 billion or what have you, but they also have the ability to do what's called unitization. And this is something that we've spent significant amount of time, and we're not able to do that now, but this would be a stepping stone in the right direction. And 2 years down the road, or whenever the time would be, when we have the accounting and the custodian that would be able to implement it, then we would be able to move into more of a unitization type of accounting structure that would then allow us to do, that piecemeal kind of the smorgasbord. I want 25% here, I want 5% here. And then that would be easier, but at this time, it's not a viable alternative.
Go ahead, Representative Obermuller.
Thank you, Mr. Chairman. So in summary, with this plan, are we moving from 20 different allocations to roughly five? I mean, kind of rolling it back to where we started here?
Mr. Chairman, Representative, that is, if you go to, I think that was page 5 or 6. What was, where are we? Page 6, when you see on the horizontal axis, when you look at it, cash isn't really included, but you're looking at low duration fixed income, core fixed income, long duration, and total rate of return. And then
when you say pipes, which handout were you referring to in page?
Oh, I'm sorry. My original,
yours?
yes, this one.
Okay.
And so when we first started this process, we said, the keep it simple, stupid. Let's try to get this as tight as possible and not offer all of these others. But we knew when we went through, there's going to be certain instances like the LISRA, like the reserve accounts that potentially would cause us to add. So in that instance, then we would just add one more of that horizontal bucket, which would be liquid total return or whatever you want to call it, a liquid alternative.
All right, continue. I think we're back to you, Josh.
Okay, great. Thank you. the liquidity issue is an important one to note here. If you've got a pool of money allocated according to an investment policy, and you have, in the case of 7X, 14% of that called away at once, you're going to be, if you're not liquid, you're going to be way off your targets. So this does, from our perspective, work best if you keep the reserve liquid. And on Patrick's sort of list of structures, you probably do need another one on there that is the reserve funds. The best way, of course, is it probably won't surprise any of you to hear me say this,
So,
but the best way to.
Josh, if I can interrupt you for a second, the point you raise is something we talked a little bit about earlier today with the vice president, and ultimately, in some of those instances, if you get caught cash short, so your cash project, you significantly, there's events that just overtake you, and so you significantly underestimated the amount of liquidity you need at that point, that we had some discussion about, borrowing facility and to get you through those crunches. And so we had one question, or one thing we talked about today, and I think the vice president brought it up, is using some of the funds that essentially are required, or determination is to leave them fairly liquid, like the state agency pool, to create either externally or internally, like through the state agency pool, some type of borrowing facility, just in case you do get caught short. Does that make sense to you?
Well, Mr. Chairman, it's certainly a tool that corporate treasuries make frequent use of for liquidity management. I don't know that internal borrowing simplifies things, and external borrowing obviously has costs associated with it. But absolutely, these are all variables that can have some influence on what you end up doing here.
Okay, thank you.
Yeah.
All right, so go ahead and now continue, please.
Great. So on page 4 of our presentation, we just wanted to illustrate for you what the investment range of outcomes looks like. This is using our stochastic modeling, and essentially what this does is it takes our base assumptions about risk and return for each asset type, and it runs and generates 1,000 different scenarios of randomly generated outcomes. And one of the things that we also add into this is, equity markets are not normally distributed. So, the 2008 type markets, those aren't really once in 1,000-year events. They happen more frequently. So without getting too much into the weeds here, one of the things that we do build into this sort of range of outcomes is a more realistic distribution of equity market returns that is not nice and normally bell-shaped curve distributed, but actually have a bit of a fatter sort of downside tail to them. And so on the top half of the page, you can see what this looks like for 70-30, and we're looking out over the next 7 years. And on the bottom, 50-50, and you can see when it's 50% equities instead of 70% equities, as you'd expect, the sort of base case sort of 50th percentile return is lower, but the range of outcomes, especially on the downside, is also better preserved on the downside. On page 5,
Josh, as I look at those charts on page 4, when I look at the 70-30 compared to the 50-50, what I see is, you see what you have, obviously with the 70-30, you've got a broader range of potential outcomes among all your simulations. But one of my takeaways from that is, unless I'm reading it wrong, is if I look at the downside at the 70-30, it's a little bit lower. There's a little bit more downside on the 70-30 there's on the 50-50, but not anywhere near as much as there appears to be an upside on the 70-30 versus the 50-50. So, why my takeaway on that is, why wouldn't you why wouldn't you, with that potential upside and then only a marginal amount of additional downside, why wouldn't you want a 70-30? I mean, that's one of
Mr.
the
Chairman,
takeaways I get from that.
yeah, Mr. Chairman, that's actually a very astute observation, but the key here is there's no cash flows. So if you knew you had no cash flows, this would be easy. 70-30 at least from a risk perspective, maybe even riskier. But the next phase of this, though, is we need to build in some cash flow scenarios.
Okay, keep going.
So page 5 is just, again, past is not a guarantee of the future, but just looking over the past 5 years, if you had invested $100 in 3 different portfolios, 70-30, 50-50, or your current reserve fund investment vehicle, which is the state agency pool, this is illustrating for you what the total returns would have been, as well as some sense of what the risk profile is in terms of, how much volatility exists in those different return streams. On page 6, we illustrate the cash flow scenarios that we described. So I'm going to focus primarily on scenario 1, because to me, scenario 1 is the one that you really worry about, and that's where you get sort of maximum draw in the first 3 years in a row from the reserve funds, and then it tails off from there. The others are, scenario 2 is kind of the same total level of distribution, but it's more spread out, a little bit more sporadic. And then the third scenario is a little bit more of a sort of steady, sort of smaller but steady draw on the reserve funds. And but I'm going to focus mostly on scenario 1, because what we're really trying to do here is stress test for adequacy, given sort of adverse market and adverse cash flow scenarios. So scenario 1, we summarize the results on page 8, both with the 5x on the left, 7x on the right. So on the left, your starting value is $100. On the right, it's $140. And then we show you and I would maybe just focus to start on the 3 years. So as we look out over the next 3 years, if you start with 5x and a 70-30 asset allocation, you can see, when we ran the 1,000 scenarios, the one right in the middle, you end up with out of $100. And keep in mind, you spent 60 plus in the first 3 years, you end up with $50. Down at the first percentile, that's saying where the 1,000 scenarios we ran in the first 3 years, the 99% of them were better than the first percentile. So it really kind of gives you, I think, a pretty good sense of really bad market downside risk. You're pretty much close to insolvent. And so and in fact, if you look at over 5 and 7 years, kind of first percentile, you do become insolvent. So one of the sort of takeaways from here is if you're only at 5x, 70-30 might be too much risk, especially if you have this type of scenario where you have significant persistent draws for a couple of years in a row on the funds. 50-50 holds up better, and it's got less downside risk. So this is, Mr. Chairman, I think part of the answer to the question you asked. If you start with 7x, though, in this cash flow scenario, you can see that you don't exhaust it in those sort of really bad market and cash flow scenarios. And you can see this on graphically on page 9. So page 9 shows you, again, that range of return outcomes with the 70-30 portfolio, starting with the 5x reserve fund, and 3 years right out of the gate where you're drawing the maximum out of this. And you can see when, down there around the 99th percentile, you're sort of flirting with insolvency pretty quickly. But at 7x on the next page, 7x can probably tolerate much better the 70-30 type portfolio risk. So this is, I think it was Senator Hicks that sort of made this point earlier. If you have a larger reserve, you can handle more investment risk. More investment risk means higher returns over time. But if you're only starting at 5x, that is probably not enough for this 70-30 type of risk. You might want to be thinking more in terms of 50-50 risk. But if you go back to page 5, you can see that even over the last 5 years, which includes pretty bad start to this year, that's still better than what you've been getting out of the SAP.
So Josh, and just, it seems to me that, this is illustrative of a situation where we have no funds to add into the reserve accounts. In reality, just knowing how our funding mechanisms work, if we had a 5-year event, we'll have the opportunity to add additional dollars into our reserve account if we have to, if we prefer to go with a larger 70-30 return. So, so it's not a closed book, is my point is, and so I think we need to take that into consideration as part of, as we, develop our plan.
Great. Mr. Chairman, Representative Nicholas, yeah, we did not assume any new cash flows into this. So you're interpreting that assumption correctly.
Not every fund has cash flow.
So following up on that, Josh, but also essentially we're doing the asset allocation on an annual basis. So we can go, if we start at 70-30 and after the first year recognize we have the potential for insolvency, we can just then roll it back, correct?
Mr. Chairman, Representative, the asset allocation is updated every year with the IFC. I think the legislative input into that historically has been in statute and currently is represented as a maximum level of risk that's acceptable for the permanent funds.
All right. Other questions? All right, continue, Josh.
Mr. Chairman, the rest is just more numbers and pretty charts. I have conveyed the essence of what I had hoped to convey and would be happy to answer any questions that may remain.
Okay. All right, is there any other questions for Josh? Any other questions for Josh? There appearing to be none. Patrick, you want to put any finer points on any of this so far?
Mr. Chairman, just one other comment is when we're doing the analysis, we went back with LSO and we said that 2% is kind of like in even bad scenarios, we get that pretty much any time. With the current interest rate environment coming up, that is probably on the low side if we continue with these type of rates. So that's the other aspect when we're looking at, maybe something that we could have a little bit more aggressive stance on it, because in current interest rate environment, it would probably be higher than that.
Right. Thank you very much. Right, any other questions or comments? Any other questions or comments? Is there any public comment at this point? What's that? I don't know if there's any public here or not. So, all right, thank you very much. So I think that then brings us to the proposed legislation. So Ian?
Mr. Chairman, we'll be referring to 23 LSO 181, and this is version 0.5. There was early on a released version 0.4, but there are some minor changes here after a subcommittee meeting. I intended to do some background on this specific bill, but I think we've really done most of the background on this. This is simply an execution of what we've been talking about today. It does two things, basically. It adjusts each of the 4 existing permanent fund reserve accounts to not allow them to tip back to their corpus until they've achieved 7 times their annual spending obligation. And then the second section of the bill funds each of those 4 reserve accounts up to 5 times their expected annual spending obligations. So we have made that.
Well, go ahead. I think you're just giving us an overview now. Are you actually stepping us through the bill?
Oh, no, I was going to explain that. This was based on the subcommittee's last meeting where they decided that that was the better way to go, was to provide not a 5 times or 7 times spend throughout the bill, but to initially fund those reserve accounts to get up to that 5 times level, but then allow them to build over time without tipping back to their corpus to allow them to grow to 7 times. So it's a policy decision. That was the subcommittee's recommendation. I think we've discussed the fact that these numbers are based on assuming that there is a reliable interest and dividends earnings of 2% a year. So that reduces the total amount that has to be stored in these reserve accounts because you're going to be able to rely on that income. Also, I guess I wanted to also mention that there are a number of staff comments in here, but that isn't because, often in LSO will put staff comments because they're concerned about a bill. These staff comments are simply an attempt so that someone could read this bill right off the bat and understand the policy decisions that are being made. It's meant to be kind of an education tool as well as get the mechanics done of what we're doing. It explains the Treasurer's Office as recommendation, and it describes each of the calculations that's made. So it's just made as a matter of educating people who are looking at this bill. Turning first to page 3 of the bill, you'll see that these first pages, section 1, do deal with the statutory tip amounts in each of the 4 reserve accounts. The first one on page 3 and 4 is the Permanent Mineral Trust Fund reserve account.
And so when you look at that, so it went from 150 to 245%. So did you back into that number by saying, all right, here's the spending policy, we'll subtract the 2%, so if we get whatever the spending policy was, which I think is 4.5% or whatever it is, and then you just multiply it and then backed in to see that that's essentially 245% of the. It was just a kind of you backed into that number?
That's right, Mr. Chairman. We did. It's a little more complicated than that. I mean, it does account, of course, for that 2% earnings, but it also, for example, with the Permanent Mineral Trust Fund, the full spending policy, which is 5%, is not what's guaranteed.
Right.
Instead, there's a smaller guarantee. So we only took the obligations, things they have to spend. In this case, that's 3.75%.
Yeah, 3.7.
And then we back into that. That's how we get to that percentage.
Plus the current fund balance.
I'll have to turn to our.
That wouldn't go into this number. I mean, that wouldn't have calculated.
No, that's right. In fact, that only goes in section 2 where we come up with the amount that actually has to be appropriated.
Okay, got it, go.
Yeah, here these percentages are independent of current fund balances. So that, that's as simple as that is. You've described what happens there. That's the Permanent Mineral Trust Fund reserve account on page 4 and 5. We do the same.
So we could, there's a really pretty spreadsheet that backs these up as opposed to just, you guys didn't go out and write this on the back of a napkin at the local subway or anything, right?
Mr. Chairman, I might actually point you to that because in your committee materials at the back of the subcommittee's report is the larger spreadsheet. And I think Polly did a shorter, easy one because these are the numbers that were used, but this is the document at the back of that recommendation that gives you more information, current fund balances, et cetera. So that's one you'd want to look at for more detail. Page 4 and 5 is the Common School Reserve Account funding, which goes to 420%. You might ask why that's a higher percentage, and that's because their obligation is the full spending policy, 5%. I just mentioned how the Permanent Mineral Trust Fund only guarantees 3.75% of the spending policy, but the Common Schools guarantees the full 5%, so it needs more money as a potential obligation each year. On page 6, is the Excellence in Higher Education Endowment Reserve Account. We do make a staff comment there that just notes that these other 2 accounts, the Hathaway and the Higher Education Reserve accounts, weren't initially discussed as the the core part of what was happening, but the same policy applies to those, and they're included in the bill draft, and I believe the Treasurer's Office believes that that's appropriate as well. The reserve, the Excellence in Higher Education Reserve account on page 6 is increased to 210%. That's also a lower percentage because the spending obligation for that reserve account is only 1/2 of the 5% spending policy amount. And finally, on page 7 is the Hathaway Student School Reserve Scholarship Reserve account. On page 8, it shows that goes to a 7% accumulation amount. That one's a little more complicated, as you'll see, because it also had a dollar figure. It was $12 million or the 4.5% originally. So we've just moved both of those amounts. That's based on historical spending and obligations for the Hathaway scholarships, which this reserve account guarantees the full amount of the yearly spend for those scholarships. So we took that average yearly amount and made sure there was enough there, which is $44 million for a 7 times annual spend, or 7% of the Hathaway corpus.
So what happens if, with what you just said, what happens in the Hathaway program if your annual requirement for scholarships exceeds what you anticipate? Does it gets it no matter what under Hathaway? Or do they have to scale back Hathaway to whatever the available?
Well, Mr. Chairman, I don't know what the ultimate answer is if you ran out of the reserve account, but clearly the reserve account is obligated for that overrun. And to the extent there's any excess in the reserve account, it is obligated to that, which also it means that while we've tried to account for that, and particularly with a 7 times accumulation in that reserve account. But it is true that, I mean, if the university suddenly there's a huge influx of students and they start spending significantly more money on their scholarship obligations, then this begins to, you're going to have more money in that account to reach that 7-year spend down.
Okay.
And then the second part of this bill draft that starts on page 9 is simply the funding effort. To make sure all 4 of those same reserve accounts are funded to 5 times their annual spending obligation. It's done the same way. These numbers are dependent on their current balances, and Polly would definitely have me make sure I say a couple of times that those are estimates that will have to be adjusted when the October CRAG comes to make sure that they're accurate. But they're roughly accurate right now. The total spend of these 4 amounts is $687,500,000. In consultation both with the subcommittee and with Don Richards, these transfers are coming from the legislative LSRA, which will have that money, is likely to have that money when these amounts are taken. And rather than doing appropriations, formal appropriations, we did them as transfers. And that's simply a matter of making the language more simple. It's equally effective, but that's the reason they're just stated as transfers in this bill for simplicity's sake. Again, these are amounts that are within the LSRA. I think it's been testified before that the LSRA is likely going to have, $250 million more than this amount, than this lower amount, the 5 times the spend, which is represented in this bill. Fairly straightforward on pages 9 and 10, just giving the appropriate amounts to each one of those reserves.
So what's the effect on the bill? Let's say that the legislature gets in a session and they say, we're not going to fund we don't want it to be 4 times. We want it to be. We're not going to fund or to make these transfers to equal 5. We're just going to transfer them because we don't want to spend that much money to only 4 times. Does that have any immediate effect on the bill?
Well, Mr. Chairman, this is above my pay grade, and I think there's a lot of other people, but I think what you've heard today, and I'm going to guess, and hopefully people will, but this is a continuum. The answer is the more money you have in the reserves, the more freedom you have to make longer term investment decisions. So if you don't go to 5 times, you go to 4, it means that there's more risk in going to those other investment strategies. So the less you do, the less the Treasurer's Office has the ability to make decisions to go to longer term strategies.
Okay. All right.
So my question is, what happens if we want to make it effective immediately? In terms of any advantages based upon current market fluctuations and/or, so what's the pros and cons of doing it so it goes into effect like March 1st? Patrick?
Yeah, Ian, what's that? Off the top of your head, quick.
Yeah,
Right.
Go ahead.
Chairman, Mr. Co-Chair, that would be very problematic from numerous fronts, from the accounting, but also just the asset allocation changes that would need to be done. This asset allocation meeting, which we normally do, we meet with the IFC every year. This would be a big lift to change all of those. It would take a significant amount of time to get that ready and actually implement it. The final meeting, I believe, would be in early May. Is that what we have for the?
Yeah, you're not ready to go to the process until.
Is early May for SLIB to get that through. So if we're saying between early May and July, that would be that.
You could do it, but just sit there in the current investment scheme because you're not ready. The timeline doesn't go until July 1.
We wouldn't have, correct, Mr. Chairman, we wouldn't have the authority to implement the asset allocation change until we meet with SLIB. And this one would be a big lift. As Josh mentioned, for instance, that 70, 30, 50, 50, that's just a kind of a placeholder to just show what kind of liquid or what kind of returns it would be. But we would maximize that out. We'd have all kinds of different investments. It would be a big.
So Patrick, let's envision that between now and session, that we have another 2 or 3 steps of, and we're getting close to more than a recession, but kind of a depression type reductions in our portfolio. Would this still be a good idea? I mean, what do we do if confronted with that type of situation?
Mr. Chairman.
How do we sell this?
Yes, that's a great point, that right now with the outlook of a recession quite high, the probability just continues to get up, as we've talked about before. You would much rather wait till you would see the Fed continue with their hiking cycle, which is forecast to be 4.6% by the beginning of 2023. And then also, if there was a recession, historically, equity markets would sell off as well. So from a timing standpoint, if history is any indication, you would rather wait.
Well, but I mean, why would you rather wait? I mean, what would happen is it would be transferred. You would have this go into effect. I mean, you guys deploy as appropriate, whatever, if you're going to hesitate or have you're going to invest it in the appropriate vehicles for a depressive cycle. What difference does it make whether you have it and invest it that way or you don't get it to invest until later on? I'm confused at the answer.
Mr. Chairman, let's just take reserve accounts, for instance. You're going from cash, which has been the best performing asset class that we've had, and going into 70-30-ish type
But
of.
why would you do that? As if you had the money to invest, why would you invest it in something you do it just invest it because that's what the plan is, or do you? I mean, I would assume that you would make the appropriate, and the IFC and the Treasury Office, you guys would make the appropriate adjustments to the investment policy for the time that you were in. Is that not correct?
Mr. Chairman, that is correct, but you don't have, it's not all or none. So typically when you have a very long-term 10-year forecast or whatever you're saying, even if we do invest now and it goes down a little bit more, you still want something in. So a good rule of thumb that we use when we have a new allocation is we'll put 50% to work with a 10-year type of horizon and then scale in after that. But if the thought is that you are going to have higher rates, fixed income would go down and equities would go down. So
it seems to me that if you wait, that if you say, well, we're not going to make these transfers until it looks like the market is going. I mean, now all of a sudden it seems like we're all of a sudden, one, you're gonna have to call a special session or wait a year. You get once a year to have the transfers transferred.
Well, Mr. Chairman, what we're saying is the timeline would be March, when we do the IFC meeting, and then we would have that implementation, the asset allocation into May. So that would be the time frame of what we're waiting for. But I'm not smart enough to call the bottom or pick the top. For instance, if something happened with Putin now, equity markets would be up 20%. And so you'd say, well, we waited and oops, we missed a hell of an opportunity.
But I think that gets back, I mean, what my confusion comes because the co-chairman here said, well, what he talked about if you had that, and then ultimately the answer was no, it'd probably be better to wait if we were in a depressive cycle. And I took that to mean wait to make these transfers. And so if you wait to make those transfers, then, you know, it's in my mind, you've waited until the next legislative session. If you don't make the transfers and set up the transfers in the bill so they happen at a certain time, you basically put it off for a year. And that doesn't seem like a very good idea to put it off for a year because we don't know what's going to happen.
Mr. Chairman, the time frame that we would be looking at would be having that allocation in place by July 1st.
Okay.
That would be the time frame that we would be looking at. And the other side is with Katie doing all of those changes, going into that end of the year part, that would be a very heavy lift, I believe, as well. From she could speak for herself, but we talked about timing wise that she felt. Is that?
No, I agree. I think the heavy lift is our structure earlier than July 1st. We transfer the money to put in nothing.
Okay. Okay.
And so just to follow up on that, Patrick, I mean, when the money does transfer, let's say it's June 30, then the implementation of it and how you decide to invest that 5 times amount and also any other modifications will be subject in part to the market at the time. So you may go 60-40, you may go 40-60, you may just in other words, you may slow down or you may jump in further, just depending on how quickly you implement it in terms of the total buy-in. Is that a fair statement?
Mr. Chair, Mr. Co-Chair, that is correct when we have the latitude to be able to do that. So for instance, with the LISRA, you know, we could take that 23% or whatever that we have, we could have more in that, but because of the valuations haven't been there, we've reduced it down. So those are the typical decisions that we would look at and work with the IFC and say, okay, where are we now in the cycle? With the thought process of this is really a 10-year investment and not a 6 to 12 month.
Okay. Okay.
Mr. Chairman?
Go ahead, Mr. Vice President.
A couple issues that I'd like to maybe have a little discussion on, and it gets back to one of the assumptions that RVK had in here, that the reserve accounts wouldn't be available for appropriation. And this all works if we're able to manage it without the legislature raiding the reserve accounts or changing the spending policies on any of these individual accounts. And so I guess to provide me some reassurances that I would like to see something in the bill draft that would basically say, and I understand we have to, they're reserve accounts and they're available for expenditures, but what I don't want to do is be in a situation then we start seeing a big pot of money there in these reserve accounts and then somebody just decides to go pull 100 million out for this or that. So I guess I would like to see that if we're going to invade the reserve accounts that we have in statutory, that it would take at least two-thirds majority of both houses to go in there and invade those reserve accounts. Similar with the spending policy. If we don't do that, then there's no guarantee this is going to work. It only works if the money is available for the investment professionals to go in there and invest those money and use that longer term horizon. I'm not saying we can't go in there, I'm just saying the bar ought to be pretty high for us to be able to go in there and appropriate right out of the reserve accounts. It needs to be higher than just normal general fund money. it takes 51% of the vote, so.
Mr. Chairman, that would be extremely important, because just think what we're doing. We're putting into total rate of return fund. If all of a sudden that reserve account balance would be there, let's just take common school and saying, oops, we now need to go back into an investment, an income focused fund. That would be extremely expensive. The bid offer spread getting out of those illiquids, that would be very problematic if that was an option. And as you know, from Alaska, they had what, 16 billion or whatever, and it went down to 3. That would be a big problem for us. If that was an option to happen, then I think we'd have to change our allocation just for that possibility.
So two different things. Number one, I think it would be useful in this bill to put in an explanation of what we're doing and explain that problem as part of a preamble to this bill, so that people who are 10 years from now or 15 years from now understand what happened and when we're all gone, and you're all gone. Part of the problem with what I mean, we could put in language that says it takes 2/3, and that would be explained in part in the preamble, but it only takes 50% to change that back to a half. 15 years from now. So understanding it is probably more important than the 2/3 to me. Although I don't see why can't 2/3. It's rational to do, but then if we do it, we need to explain it, because it won't. That doesn't mean it's written in stone. So.
So let's talk about what we're doing here. We're talking about trying to sell to the legislature that we're going to take $700 million and move it into these reserve accounts. That's pretty substantial all on its own. And because given our past experience in the last year with trying to convince our colleagues, at least on the Senate side, of doing something with this, I think there's just going to have to be some level of assurances that this is just not moving money around to another pot to be expended, that it really is for generating a higher level of return on our investments. This is a diversification of our economy to try to bring in more money so we don't have to do things like tax increases and have the flexibility to do some of these others. And I think those assurances will go a long ways to help getting this thing passed. Yeah. Well, I don't know if he agrees, but he's going, don't give me this thing and then tell me you want to change it in a year. So anyway, Mr. Chairman.
Mr. Chair.
Do you have any questions for Patrick or Matt?
It was a good speech.
It's a factual statement.
We've already had public comment, and so I think we're down to the bill. It's on the bill. What's your pleasure?
Move the bill.
Yeah, you were done with your explanation of the bill.
Mr. Chairman, I was. That's right.
All right, so got a motion from Vice President, seconded by Representative Overmuller. Mr. Vice President, motion to amend.
Yeah, Mr. Chairman, I would move that we amend the bill in the appropriate places and require a 2/3 majority vote for both houses to invade the reserve account, and also to change the spending policies for these particular accounts.
I'll second that.
Because, and here was, my comment is, I mean, part of me says we should be able to raid the reserve accounts, but we want to get the bill passed. And I think that being the case, we put in the bill, you cannot raid the reserve accounts, period, knowing that it's statute down the road, the legislature can put it in 2/3, but if we want it to pass, we say, no, you don't raid the reserve account. Wouldn't that, I mean, from what you're saying, I think that works better for you.
Well, Mr. Chairman, and if I may, it still would only take 51% then to change that versus it would take 2/3 majority of both houses. That's a pretty hard litmus test to pass. So by just saying you can't rate it, just takes 51% to change that.
We
So
have to strike it, pass it, then implement.
go ahead.
Tara, I missed that, I'm sorry.
Mr. Chairman, I think either strategy works fine, but to Representative Schwartz's point, you'd have to have a bill to repeal the 2/3 requirement, have that pass, go into effect, and then change the spending policy, which would be multiple hurdles, likely over multiple sessions, as opposed to a one-time 2/3 vote. Arguably 6 of one, half a dozen of the other, but they are different. And I would suggest that Representative Schwartz's strategy would be harder to accomplish, I think, unless anyone has a different idea.
So
So,
where does that leave us, Mr. Vice President? Did you have a comment or?
yeah, my other comment was the language of that you can't change the spending policies, which it's really a different issue than rating the reserve accounts. And for example, if we fall into the 1980s in the next few years, so all this, you're going to have to change those spending policies. And so to tie spending policies up, that doesn't make sense to me. And particularly by 2/3, because I mean, you could put yourself in a pickle that you don't want to be in.
Mr. Chairman, I don't mean to add one more layer of complexity, but I think another question is, do you mean tying our hands, the legislature's hands, to change the spending policies, or do you mean the amount at which the tip happens? Because they're two different things. Because here we're changing the tip amount.
I think what the Vice President's saying is, he's talking about how an appropriate number, otherwise divert. That's one.
Sure.
So, and even, and we that you shall not do that which would be or you add without 2/3 vote. I think it's going to be a amendment.
Analysis again and look at what Senator Nethercott said, is what I want to do is make it as arduous as possible to invade the reserve account by future legislators.
You shall not, but in any event, if you do, it takes 2/3.
So I guess I would look to see some recommendation prior to our next committee meeting on this. Let's one way or the other. I'm curious as to what.
You could just.
Mr. Chairman.
You can amend that later.
Yeah, that's what I'm saying, is just leave it as it is now. Give us an idea of scenarios for each one of those, which would take the most legislative action to actually invade that reserve account.
I don't think it would be a lot of work to draft both amendments and let us look at both of them.
So why not, so let's leave, so anyway, we've got the good Mr. Treasurer coming up.
I think the way you do that is to say that either it's a spending policy or the spending or diverting the reserves in any manner shall not occur except that this section shall not be changed except in a budget year of the legislature. And that way you get your 2/3 vote and you get the protection that I believe that Senator Nethercott was talking about, that it has to be by bill. and you put it in a budget year, then you get the 2/3 that Senator Hicks was saying that should occur. And then you've got both of them. Yeah, you can do it, but the only time you can do it is in a year in which the state has a budget and by bill.
So, Mr. Chairman, that would certainly be one way, but I think I can already think of a couple of ways around that, because the 2/3 is only for introduction. It's not to actually vote on it.
Yeah,
I could write a bill that 2/3 really like something in the bill, but they really don't like that part, and they'll vote for introduction.
So why don't we do this? Why don't y'all visit with Ian and figure out which way you want to go, or if you want to have multiples to look at, that's fine too. And before we can, does that work? And then so anyway, that deals with the encumbrance and the other use. But before we leave it, did you want to, in the same, then you have the spending policy issue, which is different, but certainly interrelated. And do you want to deal with that now, or do you want to think about that? What's your pleasure with respect to spending policies?
Mr. Chairman, I'm afraid if we don't incorporate it now, then we'll lose the discussion as we start to work this bill and look at it. So my preference would be to include the spending policies for each one of these accounts as they exist right now. And then obviously that's going to be an ongoing discussion.
So let me ask a question, Ian, as you look into the bill, and I don't remember are the spending policies in this same section, or in this, at least the same?
No, they're not, that I can find.
Mr. Chairman, they're still in section 719, so they're part of that same section, just not in the subsections.
Yeah, so at least for the permanent funds.
Correct. Yeah, all except for the Hathaway, they're in the same section.
So the only thing we have to do is we have to go out and pull in.
Another stat.
We have to pull in the section for Hathaway into this bill.
Well, it's actually there as well, because we adjust that.
It's just down below because we dealt with it separately. Okay, so we're not, so if we get in and talk about and deal with the spending policies, we're not talking about expanding the bill another 10 pages. We're talking about adding another couple pages. All right. Okay.
Mr. Co-Chair?
Yes, go ahead.
Yeah, I would move to amend to add a preamble, which is essentially an explanation of what this bill is doing, and explain why it's critical that the funds not be invaded.
Yeah, some legislative findings.
Yeah.
Okay. We can.
Do we have?
No, we're not going to do amendments today. We're going to have them drafted. We'll examine at the next meeting. We'll work the bill and examine the amendments. Let's get them in front of us, and then we can hopefully have a little bit more clarity of thought. Not that your thoughts aren't clear now. I don't mean to imply that at all. Okay. Anything else on this bill? Anything else on this bill?
Mr. Chairman, I don't have anything else on the bill, but I would like to talk a little bit about, once we've got a bill, and how we're going to get this passed, and some of the discussion we had that I had. Representative Nicholas wasn't able to make it with the IFC as far as getting this thing across the finish line. So I don't know if you want to do that now.
Sure, let's go ahead and do that now.
What I think we're actually going to have to do, I mean, we're talking $700 million. And I mean, for us that have been on the subcommittee, this is extremely complicated, but it's tremendously important. I would tell you, in my 12 years in the legislature, I think this is the biggest thing that we've tried to do in 12 years to try to increase funding for the state of Wyoming. And it's a big lift. So one of the conversations that was had at IFC is they said, how can we help? And so learning from our lessons from last year, what I would like to see is that we work with the leadership in the House and the Senate. And we actually set up at least some formal training mechanisms to review this and explain to all 93 members of the legislature, and bring in the investment professionals from both the state treasurer, the state treasurer's office, accounting office, and then members of the IFC have extended that they would be more than happy to help come and do that. And so no different than we do with our normal mandatory training. I would think that we would want to go to management council and set up a 2-hour seminar prior to or the first day of the session and say, it's a big deal, folks, and bring in the treasurer and his staff and have them explain it to get this thing across the finish line. But
Yeah,
I think that makes our job so much easier versus us having to stand up and explain
try to
it,
sell it.
is to have the treasurer, Patrick, the entire STO staff and the IFC set up and say, this is something you guys should really do.
So we could do it the Saturday before caucus, so we could have a joint caucus of all on a Sunday, or we could even do it on a Monday morning. But just figure out the time and place. But I mean, if we don't do it, I mean, this thing could spiral out of control really easily.
It only takes a couple black helicopters to kill this thing. I'm just telling you. Yeah, well, I don't fly them. I just shoot them down on occasion.
No, you got presumptive leadership of the Senate kind of covered in here, but not so much in the House. So we all.
I'm just asking for input back from the committee. If this is something you guys, and like I said, the IFC said they would commit time to actually making sure that they would be available to help push this thing through the legislature.
I think that, so my initial reaction is, I don't know how I don't think it passes if you don't. You're gonna have 32 new House members, and you're gonna have 8 new Senate members. And so, I mean, and then you're gonna turn around and without that, you're gonna ask them to vote on on $630 million, $700 million. That's a good, that's a big deal, and it's when you don't understand, it's just much easier to say no.
Yeah.
So I don't think I think if you don't do that, I don't think it passes. But that's my 2 cents.
Well, we'll take it to our respective bodies and we'll just get it on the agenda if they agree to it.
Well, I just wonder if this committee ought to just make a recommendation to management council to already start planning to block out the time and the date and the location to do this. Would be my, if the CAPFIN wants to make that recommendation back to management council to get that done.
Do you want that recommendation to come from the chairman, the vice chairman, and me?
Yes.
In the form of a formal letter or memorandum?
Yeah, absolutely.
Okay, can we do that, please? Is that okay with you? All right, so let it be written. What else on this bill? Anything else on this bill? All right, we'll go ahead and just table, but just move that, lay that back until next meeting. Why don't we take a little 5-minute break and stretch the legs and come back and we'll finish up. Sound okay? There we are. Mike, you're back. Doc, you're back. Can you hear us?
Right here, Mr. Chairman.
Doc, you okay? You can hear us? Yep. I'll take that as a yes, even though you're on mute. Okay. With that, Polly, go ahead.
Thank you, Mr. Chairman. Polly Scott, LSO Budget Fiscal. And returning back to the subcommittee report, the subcommittee recognizing that they were going to be recommending an appropriation or a transfer from the LSRA, they also undertook to examine LSRA obligations and evaluate if there were any revisions that could be made on those. And so I will share the memo. The memo is in, it's document 8-01 on the website, and it's also in the subcommittee report. The subcommittee asked LSO to summarize the current obligations on the LSRA. And so this chart has them grouped by appropriations for the 23-24 biennium, also the borrowing authority, and there's one guarantee. The subcommittee, so this document that I'm sharing, the table is LSO's summary. And then the subcommittee discussed them, and they identified 8 that they thought could possibly be considered for changes or revisions. And they arranged, they invited stakeholders to come to this meeting to talk about what any changes to these provisions would mean for them. That invitation went out a little more than a week ago, and so the word's still getting out, and so I don't think we've had a lot of participation from the agencies, and the subcommittee knew that might be the case, and so they think this should continue to be discussed through the November meeting. But these are the, pardon me? These are the recommendations that they have brought forward for things that could be considered for changes. And that's really the summary that I have for you.
Okay. Thank you. We have any members of our subcommittee want to add anything to the presentation by Polly?
So, it's fairly simple, really. We just went through the various uses or guarantees or backstops or loans that LSRA has. And look, why do we create them? Are they still needed? And if they are needed, how much of it? Are the numbers right? The concept being, we would like to take it, because of the dollars we have, as you can see, is currently allocated, it limits our ability to invest the LSRA in a more advantageous way. And so it's pretty easy to walk through it if you go to page 2, where it starts, or to the graph. On the ones that we highlighted, that we
talking about on page 4 of 6.
That's 2 of 4.
Recommendations 2 of 4. Okay.
Borrowing authority. Just go down to the Veterans Skilled Nursing Home. We allocate $9 million. There's $3 million that's used to date. The question is, do they need the other $6 million for allocation for that? And so that's a question posed to them. On UW housing account, we've been informed by UW that they don't need the 40, they don't plan to use that $49 million that's out there. Or the remaining balance that is out there. So, and it reverts at any rate. So we're going to reduce that down on the student housing account. Interfund loan transfers, whether or not the 60 million is needed, I think is a question that we need to have answered and addressed. The transitional borrowing, that's number 6, school districts moving to employees and official groups. The only school district that was examining that was Laramie County, that we don't believe that's going to happen. So we were told that basically they don't need 60 million. And even if 20 million would be more than enough for that, but we may be able to take all that fund out. With YDOT, we made the transition to the state agency pool versus LSRA, just because it's more of a liquid fund. And the real question is 200 million also then the right number? If you take what their annual biannual budget is, 200 million, and basically this is if the federal government shuts down. And is it realistic to presume that it'll be shut down long enough that they can't pay $200 million in their bills? And my guess is that 100 million is probably sufficient, but we would like them to come back and ask us about that. So, that's just the process we went through. And in the draft bill, then I think it identifies 8 different ones that we need to put numbers in to if we adopt the bill.
All right, which it kind of sets us up to go through the proposed legislation, we also have this item of stakeholder and interested parties. Is there anything we need to visit about on that? I saw there was the memorandum that went out, I think, from y'all to them. Was there anything to report on that we need to hear about before we move on?
Mr. Chairman, we did have a little bit of response from a couple of stakeholders, but just to reiterate, this only went out a little bit more than a week ago, and so some entities haven't had time to respond, and I believe that Representative Nicholas has already started the process to request these agencies and any involved agencies report on their views on this when they come for their budget hearings in December as well.
Yes, go ahead, Representative Larson.
So not being aware of the work that you guys have done on this, as I read through this memorandum, seeing that Department of Workforce Services on the unemployment compensation, I sent them an email, and I think Beth is here that could explain Workforce Services on number 4 on that 20 million that's used there, if you want to hear from her, and see if we could eliminate that from the LSRA.
Okay, go ahead and do that. Come on up.
Hello, thank you. I am Liz Gagan from the Department of Workforce Services, the Deputy Director. Director Cooley was unable to make it today, but I did want to speak to recommendation number 4, which is to eliminate the $20 million in authority for UI loans. The department has no objection to eliminating the $20 million. Wyoming's current UI trust fund with US Treasury is the second most solvent in the United States. And in addition to that, we have a state trust fund that has a current balance of $51 million that we could use to pay benefits if the other fund wasn't enough. So by all means, if you eliminate that $20 million, there's no objection at all.
All right, thank you. Any questions for? Great, thank you. Appreciate that.
Thanks, Liz.
Is there any other stakeholder information or? So anyway, that's good. That's great news. And then I guess, and so we're only looking at these borrowing facilities, and the appropriations have obviously been appropriated. So those are not talking about those necessarily as far as any kind of elimination. So with that, I think we can go ahead and move into the proposed legislation unless you have something else.
Yep, and Mr. Chairman, before I do, I would just note 2, I think, additional pieces of feedback that were received, or I believe were sent to you and the Vice Chairman First, for the EGI, I believe there was no objection to repealing that borrowing authority. I believe the 60 million, yes, number 6. And then for YDOT, I believe Karen forwarded a response that they were agnostic on the source of funding, which is what the bill draft does, but their preference was to leave that 200 million amount the same.
So in response to that, I think we need to ask them why. I mean, and how often have they ever been shut out more than 100 million?
Yep.
You know, federal shutdowns.
I mean, at the end of the day, if they had a federal shutdown, I mean, so what happens if there's a federal shutdown for 30 days? I mean, and how much money they need to keep going? I mean, that's what this is about, is funding road projects for, a period of time. So, we ought to go back and ask them specifically what that would be for 30 days or 60 days.
Yeah.
And if you go back and look at federal shutdowns, the longest one was probably during Reagan, and it was 10 days. I don't remember, it's a while ago.
Yeah, Mr. Chairman, definitely can't answer those questions.
We're just saying, okay.
Yep.
Show me.
Yeah, we're from Missouri today, so show us, yeah.
Yeah, and Mr. Chairman, that's something that, we could invite the Department of Transportation to speak on at the next meeting.
Yeah, great.
Yep. So, Mr. Chairman, 23 LSO 262 working draft .4, this is 8-02 in the meeting materials. This bill draft would amend or eliminate what are now unnecessary or obsolete borrowing authority or guarantees from the LSRA. The 8 instances of that in this draft reflect the 8 recommendations from the table that Polly just reviewed. One thing I would note is that this bill draft really is independent from the previous discussion, kind of the similar aim, but very much independent of that draft. One does not need the other and vice versa. The staff comment on page 2 just notes, and most of the staff comments here are explanatory in nature, just explaining what is happening in the bill. This staff comment just notes that in several places where the recommendation was to reduce a certain amount of borrowing authority or guarantee, the committee would need to supply a figure for that. So the first change on page 3, lines 1 and 2, and lines 10 and 11, this is an amendment to 91418. This is number 7 on the list of recommendations, and would change the authorization for YDOT from what previously was referred to as pooled fund investments to the state agency pool. It does not change that amount on lines 3 and 4. The staff comment just notes that I could find no instance in statute where we actually refer to the state agency pool. And so the committee may want to consider whether some other explanatory text referring to the state agency pool may be helpful.
So by the way, when you read this language, it says any one time they can obtain a loan not to exceed 200 million. So theoretically, they could do 200 million, and then two months later, they could do another one. Because it doesn't say one time. So if we drop that to 100 million, then if they need 2 months worth, the first month they can ask for 100 million, and then for the next month, they're going to do it again. I don't see any reason why we can't put it down to 100 million.
And
keep that in mind.
Yep, Mr. Chairman, then moving on to page 4, lines 22 and 23. This is number 6 on the list of recommendations. This is 93205E, which allows for the interfund loan for purposes of the EGI transitional borrowing. That's the $60 million figure. The amount on line 23 would need to be filled in.
So I think based upon what we have heard, we could probably strike this. I mean, it's okay to take it to 0, then why do we need it?
Yeah, and certainly, Mr. Chairman, Mr. Vice Chairman, that's a decision of the Select Committee.
Okay. Keep going, Brian.
Yep, moving on to page 5, lines 28 and 29. This is 94219B. which is number 8 on the list of recommendations. It currently requires an amount from the LSRA be transferred to the school foundation program account to ensure that that balance is $100 million in the school foundation program account. And this change would just specify a maximum transfer amount from the LSRA to meet that, that obligation under this subsection.
What would it take to do, we discussed this a little bit earlier, this is $100 million, and maybe, and I think our discussion with Don Richards was that maybe that number should be closer to 300 million. And it shouldn't be here, it should just be changed to where that account is now $300 million. So actually would remove the borrowing authority and just have that appropriation there for $300 million. Is there any reason why we wouldn't do that?
Mr. Chairman, are we talking about the same thing here? One of them is the borrowing authority for cash flow issues, right? This is just an auto appropriation that shows up as a $100 million transfer of the school foundation program. Those are two separate issues. So which one are we on, Brian?
Mr. Chairman, Senator Hicks, it's the latter. It's that transfer to get to the 100 million.
So all this is, so, okay, and so what, I understand.
I would concur. I think we had to modify this.
Mr. Chairman, I don't wish to interrupt. However, your members that are online are not able to hear you unless you actually are speaking into your microphones.
I'm sorry, we were talking about our virtual members and we didn't want you to hear what we had to say, so now we'll try. Go ahead. Go ahead. Why don't you start over again, Mr.
Sure.
Vice Chair?
I would concur that this is that 100 million that we spoke of earlier today. I think Don Richards told us that it's insufficient. This number was created back in the 80s for the purposes of you know, what goes into the balance of the school foundation program. That number, I think we understand to be roughly 300 million. I think that's correct. But instead of putting a no transfer made on LSRA, I think we need to just increase the amount.
Mr. Chairman, I think the 300 million was the cash flow borrowing that happens on a regular basis, and then the number 8 is the guarantee to the SFP program to bring it up to a minimum of $100 million. So currently the estimate for what that's going to be is 128 million, and that's estimate will be updated. And also, I just wanted to mention, we have had some emails from the CFO of the Department of Education, Trent Carroll, and he is out of town and not able to participate in today's meeting, but wants to participate in this discussion.
So I still think we're not talking apple. I think we're talking apples to oranges right here. So okay, let's keep going. We'll come back.
Okay. So, Mr. Chairman, I think if you go back up to the memo that Polly had, it clear this up. So number 5 was consider limiting Department of Education. This is the school foundation program borrowing that they're already currently, they have unlimited borrowing authority. They have a cash flow problem of about $250 million a year. One of the things that Mr. Richard discussed is maybe moving that over to, again, it's a loan, and I wrote a note down here, was maybe that's one of those ones that we want to use to look at borrowing out of the agency pool instead of the LSRA. So that was the borrowing authority. Number 8 on that memo is the school foundation program, where we just do the automatic transfers that starts out every year with $100 million in the school foundation program guarantee. Is that?
And Mr. Chairman, on that change in 94219, so on page 5, that's number 8.
Okay. Yeah, number 8 on the memo. But again, Mr. Chairman, I would like to explore maybe what we put on there is on that number 5, back up to the borrowing authority is actually look at moving that. And again, this is the cash flow issue, moving that onto the state agency pool. And I think what I'd wrote down is a jotted a note that was something that Mr. Richards said that they'd be able to do from a cash flow standpoint.
I would concur that we ought to look at examine this and the other things that anything we move to state agency pool, see if it works without impacting state agency pool. And I presume it needs to be roughly 250 million as well.
Yeah.
Okay. All right, so keep going, Brian. Oh, go ahead, Representative Larson.
So, Brian, if you could, on that number 8, that 128, that's the estimate, the 100 million that's in that's because the funds haven't been transferred yet. We let them have that cash basis to deliver out to the school districts, and then that's backfilled, right?
Yeah, Mr. Chairman, Representative Larson, yeah, this would be a backfill that just puts that SFP balance at $100 million.
Well, but my question, I just want to get my head correctly what we use, what that guarantees for. And do we not use that because of the timing issue of funds coming to the Department of Ed?
Mr. Chairman and Representative Larson, I do believe that is the case, that it's a cash flow matter. And it's a good, the subcommittee has recommended that the discussions about this continue into November. And so we could have Matt Wilmore testify about that.
Yeah, and so Mr. Chairman, that was my recollection, is that that's a timing issue, and we let them take that money out of the LSRA to get to their distribution to the school districts. Then when that money comes at the fiscal year, then that comes back and backfills that amount if necessary. And so my question is, if I'm accurate on that, it seems to me that would be a good one to come out of the state agency pool, because that's just an in and out.
Hold that thought. My recollection was, and maybe that never passed, but it seemed like a couple of years ago, we quit charging interest on that interfund loan because it just put the school foundation program further in the hole. And so we'll have to revisit that if it's coming out of the state agency pool. Then I think that's a different matter.
Fair enough.
Yes, go ahead, Representative.
Yeah, thank you, Mr. Chairman. The 128 million is that's basically the deficit. That's the backfill of the deficit in the school foundation program, is it not?
Mr. Chairman, Representative Overmuller, yeah, this is the backfill. The next section that I'll discuss in the bill, I think very clearly goes to Representative Larson's question about the cash flow. That's the big interfund borrowing that takes place.
Yeah, but just to follow up, so this isn't ever paid back or dealt with later. This is just, this cures the deficit, and that's the end of the story, right?
Yeah, Mr. Chairman, Representative Overmuller, this backfills it, so the ending balance is always at 100 million.
Yeah, so just to follow up then, when you consider limiting that number, then the backfill has to come from somewhere, because this is a deficit that has to be covered. So, just a point.
So, Mr. Chairman, part of the discussion, as I recollected at the subcommittee, is so we create a dual process here, because we just automatically transfer 100 million for the deficit, but we don't know what the deficit is. So then we come back and we run another appropriation. And so the idea was just to get rid of it. At the end of the day, we're going to true up the school foundation program and pay for it, rather than have an auto appropriation and then have to come back and do another appropriation. It just cleans it up. I think it makes it simpler. At the end of the day, we're going to fund that, whatever that deficit is. And keep in mind, we're going to take $330-some million out of this and put it into the Common School Permanent Land Fund reserve account. I think it cleans up the LSRA, and we don't have to true this up. We're going to true it up at every budget cycle anyway.
Yeah, so the real question is, it's a big enough issue that should we do all that together in a separate bill as opposed to this?
That's one where we probably ought to pull out and run as a separate bill.
Let's hold that thought for a minute and keep working, through the bill, because we may, who knows, maybe this will give birth to several others as well.
Yep. So, Mr. Chairman, the next change then would be number 5 on that, on the list of recommendations, which has been discussed. This is 2113-316A. Currently, it authorizes interfund loans to the school foundation program account, really for cash flow needs.
And that's unlimited.
Yep, it's unlimited. This is where it says the loans may be made from the LSRA. I think that's where the discussion about changing that to the state agency pool comes in. And then it says if LSRA is insufficient, then it would be borrowed from the common school account itself. And the new language would just specify a limit for borrowing from the LSRA. That's the new language on lines 4 through 7.
And it puts a limit on it so that our friends at Treasury know that everything above that amount can be otherwise dealt with, otherwise invested. Where right now, they have to make that assumption because there is no upper limit. Okay?
Yep.
So I just have a question, Patrick. What do you do when you see these unlimited borrowing authorities? How do you determine what to do?
Mr. Chair, Mr. Co-Chair, we do not take the liquidity that would be needed into account on that one, just because it would be so detrimental to hold that in cash for a potential. But what we do have is just the liquidity in the fund that if it was pulled, we'd be able to do it, but it would be costly. Not tremendously, exorbitant like I was talking about the illiquids, but it would be bid offer spreads would cost funds to sell.
So what you're saying is that if you have unlimited borrowing authority, you don't worry about it.
Mr. Chair, Mr. Co-Chair, any borrowing authority that we have to take into consideration. But most of those funds that they're borrowing from or what have you, like the LISR or what have you, we know that we have that liquidity as we talked about.
Is that because it's liquid? Yeah.
Mr. Chairman, Brian, do we have a history on what that number has been over the years that they've had to borrow on an annual basis?
Mr. Chairman, Representative Larson, I believe we are looking into getting the exact history. I think, if you'll note on the chart, it's, I don't know if that's the average or the most recent, but 250 million.
And so, Mr. Chairman, we're probably looking at putting a number similar to that in there for the guidance. Is that correct?
I would assume.
Yeah.
Mr. Chairman, instead of unlimited, again, I think the recollection with Mr. Richards this morning was probably 300 million. I think what he had suggested, we would look for borrowing authority instead of unlimited.
But this, and Mr. Chairman, this is the one you said that we, and I do recall making that change to where we don't charge them interest. So if we come out of the state agency pool, we've got to revisit that.
Mr. Chairman and Representative Larson, sorry to interrupt, they do pay interest on these loans from the LSRA for the cash flow borrowing, if that's helpful.
How much?
I believe it's the prior year's
2% or prior year?
1.5.
I believe it's probably, I'm not entirely sure, so I'll follow up with you, but I think it's based on the prior year's
Yeah, so that means it's 0.5% or 1% at most. Recently, anyway.
Okay.
Mr. Chairman and Co-Chairman, the percentage is the last fiscal year's annual return for SAP. So it's very small.
Yeah, phenomenal. Best deal anybody's going to get.
So if there's a negative, do we got to pay them?
Yeah, if there's deflation, no, we don't.
Well, we did that for the counties too.
Okay, keep going, Brian.
Yeah, Mr. Chairman, next page 7, line 27, this repeals 273303E. This is number 4 on the list of recommendations. That was the subsection that authorized interfund loans from LSRA for the unemployment fund.
Okay.
Then moving on to page 8, Lines 40 and 41, this amends a session law 2019, chapter
So,
1.
Brian, going back to that one, on that one, we actually just eliminate that. Would that be a repealer then, if they don't need it and we don't want to do that anymore?
Mr. Chairman, are you referring to the EGI?
Yeah.
Yeah,
No, we're talking about I thought you were just talking about the unemployment.
Yep, so Mr. Chairman, yeah, this would eliminate that borrowing authority entirely.
Okay.
Yep. So this change to session law from 2019, this is number one on the list of recommendations. This authorized borrowing for the Veteran Skilled Nursing Center. The limit was up to $9 million. This changes it to $3 million in accord with the current outlay. The staff comment just notes that the committee would need to confirm whether that's the appropriate number or if some other number is appropriate for that amendment.
Okay.
Then moving on to page 10, the change on lines.
Representative Larson has a question.
So we're dedicating that thing here in a couple of days, and next, or not too long, so do we not know where we're at on that, or this is for the operational loan, right?
Mr. Chairman, I do believe this was for
Construction.
the construction.
And we're just,
We might be able to.
yeah,
And
thank you.
Yep, and Mr. Chairman, Representative Larson, I'm not sure what amount of that outlay has been repaid yet.
Okay. Thank you.
Okay.
Moving on, the change on the bottom of page 10, this is an amendment to the UW housing bill from 2019. That's just a conforming amendment. On page 11, the change to line 17 through 20 and then 31 through 34 would specify that these appropriations, $15 million for initial construction costs for phase 1 and phase 2 of that project, and then for the $34 million for repaying any securities that were previously issued. This would revert those funds, that $49 million, back to the LSRA on June 30, 2023. And that's number 2 on the list of recommendations from the chart. And then finally, Mr. Chairman, the last change on page 12, lines 5 and 6 amends the budget bill, which authorized borrowing amounts necessary from the LSRA for cash flow for the Hathaway scholarships. And that would be a place to insert a monetary limit for that borrowing authority. And that was, Mr. Chairman, that was number 3 on the list of recommendations.
Okay. Thank you. Is anybody else here to talk on this working draft bill? Anyone else here to talk on this working draft bill? No one online? No one in the room? All right. We have this working draft bill. Gentlemen and ladies, what are your pleasure?
So, Mr. Co-Chair, we have sent out a notice to all of the agencies that are impacted by this, that we're going to continue to take comment, either written comment and or specifically have them when JAC meets in December, and we have any agency in front of us that they can address us there as well. So I would submit that I would move that we table any further work on this until we get full comments and feedback and comments from the governor's office as well.
Yeah, Mr. Chairman, I guess I would concur with that, but I would like to have some follow-up and some discussion as far as the source of the borrowing authority for like the Hathaway Scholarship Fund and the School Foundation Program for the cash flow needs, and see if those are something we could shift onto Pool A versus leaving in the LSRA.
Yeah, and I think Don has been listening in because we've asked him for that information, but let's just make sure that that our suggested comments and use of school agency pool is capiche with everybody.
Which kind of begs the question on a couple of these things. I mean, so for example, on Hathaway borrowing, why do you need that any longer? If you go to a 5X on Hathaway Reserve Fund, do you need that borrowing authority anymore? I mean, you've gone to a 5X, you're gonna make some determination about what may be needed there, but you know, in some of those, you even, and a couple of these like that one, we may not even need borrowing authority anymore if we go to 5X on our way to 7X.
Well, not only that, but on the Hathaway, it's 7%, or times 7, I think, the way it's currently drafted. I think the Hathaway is unique, and it is. So we need to have that examined.
But there, anyway, Hathaway is just a different animal than everybody else. Anything else on this bill? Anything else on this bill, members of the committee? All right. I think that finishes up with that. Anything else, Brian? We're done with that. So now, Senator Hicks, we're down to item number 9 on the agenda, which is active admission, which refers, I believe, to the active admission for Wyoming, and not that you're going to admit anything today that you've done that you should not.
I'm going to claim the Fifth Amendment on that, Mr. President, or Mr. Chairman. So this actually come out of a conversation that we had at the Treasurers Conference, and we were looking at trying to develop a total return policy for our different accounts. And so we had speakers there from, I believe, New Mexico. I don't remember if Idaho was there, but certainly there was some discussion about how Idaho has structured their school finance programs. In both of those states, and I don't, I'll have staff talk about what the limitations are based on the active admission. There's a memo there. But both of those states just went back to Congress and had their active admissions changed so they could pursue a higher rate of return with their school foundation program accounts or their similar accounts to ours. And so I had asked staff to go see how arduous a process that was. When did it happen? Give us some background. Is this something that we would want to pursue here in Wyoming? And actually, it was a pretty interesting memo. And I guess with that, Mr. Chairman, I would turn it over to Brian to walk through the amendment or the memo and explain it. But it's certainly something I think we ought to entertain.
Go ahead, Brian.
Yeah, Mr. Chairman, members of the committee. First, I'd just like to acknowledge Emily Wangan, our legislative editor, who put together this memo, did the research into the state level actions that Idaho and New Mexico took, as well as the congressional actions for the bills that amended those states' active admission. So she put together that, as well as the appendix that comes with this memo. In terms of just a couple of prefatory comments, you'll see from the way Idaho and New Mexico approached the changes to the active admission, lends to the theory that there's not one way to do this. Idaho was very formal in that there was executive branch and legislative committees that reviewed kind of their state work and their state investments of permanent funds before passing a joint resolution that asked Congress to amend their active admission. New Mexico's appeared to be a bit more informal and really had its genesis from a letter from the governor to one of its senators asking for a change to the active admission. In both situations, what ultimately happened was a member of that state's congressional delegation introduced a bill in Congress. Both of these passed Congress as standalone bills. The table of actions, so Idaho's on page 2 of the memo, seemed to be quite quick in terms of how they were reported and passed. In some cases with unanimous consent. The House, for example, suspended the rules to pass both of these bills. Same for New Mexico, a pretty similar table on page 4 in terms of how these passed. In terms of the actual legislation, they were a little different. Idaho's active admission amendment basically deleted an entire section of the active admission and reproduced it in this congressional legislation. New Mexico's was a little more narrow. They struck certain phrases and inserted new language into existing sections. So with that, Mr. Chairman, I'm happy to answer any questions. I can go through, I guess, what each state did specifically with their amendment or with the congressional legislation, but happy to proceed as the committee sees fit.
Go ahead, Representative Schwartz.
Thank you. So I will admit, initially when I saw Senator Hicks wanted to get into the active admission, I feared we would be seceding from the union, but I'm relieved to see that's not the case. My question is, I've had an issue with the miners hospital for years, and that's part of the active admission as well. So the question is, do we know, I mean, should we be looking at the entire act? Because I think we can only go to Congress once. To make sure we're covering all of the restrictions that we are uncomfortable with.
Good point.
Well, Mr. Chairman, and I think that's probably right, but I would still encourage us to focus on single subjects to do that instead of trying to do an omnibus active admission change. Although, if you look, and I believe it was Idaho, they changed several items in there. In fact, the way they lease school trust lands changed some of that. I think you got to be very careful, but I would hate to jeopardize the ability to get an act that would allow us the flexibility to increase our returns on our school trust lands and our common school common land account based on the miners hospital.
I've got other ones.
Okay. Anything else? Anything else, member?
So, Mr. Chairman, the only thing that come in, and I had LSO go ahead and just draft up a resolution, but there's really, the question I think before the committee is how do we want to attack this? Do we want to go through a very formal process, like through a legislative session and explain this or go through this? Or do you do, and I don't remember if it was, I believe it was New Mexico's, just had the majority and minority parties in the legislature and the governor sign a letter asking the congressional delegation to sponsor that legislation and get that done. And I guess my preference would be the path of least resistance and just work with the governor's office and the legislature and do it through a letter versus trying to do a full-blown resolution. But I think first we should make a determination whether we want to pursue it. Second is what mechanism do we pursue? So open for discussion, Mr. Chairman.
I agree. Yeah, my recollection was in discussing this, as part of our broader discussion on a potential constitutional amendment a year ago. But Josh from RPK went through and identified a number of problems between what our current practice is and what our both the active admission and our Constitution say. So, I don't know why we wouldn't try and make an effort to align those. So with that.
So, Mr. Chairman, so I understand this. So you're suggesting that we move forward with this process of changing our active admissions. So the second part of that is do you have a preference as to how we'd like to move forward to do that?
Looking at the memo, you had one where you basically passed this act in the Idaho legislature. The other one, if I read the memo right, New Mexico actually went out and had some kind of vote that they voted to amend their constitution, and then that constitutional amendment became effective upon on the second thing when it was passed, and then two when the active admission was changed, which is that I don't think you're suggesting that, but in both those cases, obviously both of those went at least back. Well, they would have gone through the full body of the legislature, and would have been voted on by the legislature in each case, unless they did it through referendum in New Mexico.
Yeah, but, and Mr. Chairman, I'm not sure how, you know, the letter from New Mexico governor says the legislature and 2/3 of the voters from New Mexico voted in favor, which would lead me to believe that it was a constitutional resolution.
Right. So I think of those things that I think that you know, a resolution to that effect might be, you know, I would think at a minimum, I would think you'd want to do a resolution so that, and again, it's part of the educational process for the members of the legislature to understand what's going on. And you know, it's part and parcel, you know, it's also part of this, what we just went through with respect to the going to the total rate of return, one fund.
So, Mr. Chairman, if we want to go down that route, does the committee then want to sponsor the resolution? Or does that go to the Appropriations Committee, the CAPFIN Committee, or do we want to do it as an individual bill? Seems to me this is consistent with our whole discussion of trying to get a higher rate of return and free up the headwinds that this would probably be the committee that would sponsor that legislation.
Mr. Co-Chair, I would agree, and I would suggest that the committee move forward with it, have also draft the resolution, and then put together a letter to the congressional delegation in the event that it passed the House and Senate.
Mr. Chairman, LSO has already taken the,
yeah, I know,
my request, the liberty to draft that up if we want to look at it.
Presto changeo, okay.
So maybe we could get Brian to walk us through really quick what that looks like.
Man, you're fast, Brian, go ahead.
Thanks, Mr. Chairman. So 23 LSO 251, this is draft point 3. This resolution would simply request that Congress introduce and pass legislation to amend Wyoming's active admission to authorize the expenditure of earnings. I can go through these individually or just note that, you know, beginning on page 1, line 6 are a variety of recitals that walk through the history of the active admission, the investment, the creation of the permanent fund, which has, you know, become the common school account within the permanent land fund. And then, you know, the bottom of page 2, the common school account has grown over the years and invested in a way that the fund exceeds $4 billion. The investment of those funds generate earnings and capital gains that are in addition to interest that's generated from the funds. And then finally, page 3, line 8, just notes that an amendment to the active admission would better reflect the reality of how the common school account is invested and allow those earnings to be better and more efficiently applied for Wyoming schools.
And so this conforms, so like, I think it was 2 or 3 years ago, we talked about interest and we defined in statute the term earnings, and this makes it consistent with all this really does is conform it to present practice, more or less.
Mr.
Correct?
Chairman, that's correct. Yep.
Okay.
Page 3, line 19 is kind of the beginning of the ask, just that Congress enact legislation to amend the active admission to strike references to interest in sections 5 and 7 and insert earnings instead, and then to strike a reference to income in section 8 concerning the university fund and insert a reference to earnings. Then section 2 is basically a mock-up of what those changes would be to the active admission. So page 4, line 24 is section 5 of the active admission reproduced, striking interest and inserting earnings. The same for section 7, this is page 5, line 9. And then section 8, page 5, line 25, striking income and introducing earnings. And then section 3 of the resolution would be that upon enactment, copies are transmitted to the president of the Senate, the Speaker of the House of Representatives, and then to the governor, the treasurer, and to each member of Wyoming's congressional delegation.
Okay.
Mr. Chairman?
Go ahead, Senator Hicks.
I do have one amendment that I would like to suggest to the language on page 4, if they're there, if you want to do that at this time.
If you, so let me ask you, what's your pleasure? Do you want to move the bill and work it, or do you want to discuss this further and then lay it back to the next time, or what? Or you want to do this amendment and then lay it back
Mr.
to
Chairman,
next time?
my preference would be to move the bill, because then we've got something out there for the public to review, a working draft for the next meeting versus.
Move the bill.
Got a motion by Vice Chair and we'll take the second from Senator Guru on screen.
Well, Mr. Chairman, what I would like to see us do is again, a discussion I had with staff earlier is if we're going to go in here, I'd like to see us include the language that Idaho used when it come to leasing for minerals, grazing, agricultural, other purposes, provided the term, the grazing leases shall not exceed 10 years. And basically what they just did was struck out a time limitation and just basically inserted language that said at least terms that would generate the highest rate of lease for those leases. And so it leaves that flexible on making a determination of what duration of a lease might generate the highest rate of return for those leasing of those state assets, school. Basically, it's your school trust lands and your minerals and underneath that.
Okay.
And Mr. Chairman, Senator Hicks, if you wish, Idaho's active admission in terms of leasing simply says land granted under this act for educational purposes may be leased in accordance with state law.
That's the language you'd like to have there?
Yeah.
So you had that, but isn't there also some language about provided that such lease secure the maximum long-term financial return? And I think
Yeah, I think that's in Idaho too.
That's like in your appendix. I think it's on page.
Yeah.
It's on it's I guess it's 1373 is the copy of it from, but it's kind of in that first paragraph on the top of that page. You see that, Brian? It's on the next page after where you just read. Right after the crossouts.
So, yeah, certainly a decision, Mr. Chairman, of the committee. What was in their resolution isn't exactly what ultimately is not what Congress ultimately passed. So the language I had read is what Congress ultimately adopted in their active admission. This language from the joint resolution is what Idaho initially proposed. And I'm not sure what happened in the intervening that resulted in what was in the public law that Congress enacted. Certainly, whatever, the language of the committee wishes to propose is, it's certainly your purview.
We can propose language and they may do the same thing to us. Okay. So Mr. Vice President, what's your?
I just like the language that says provided any such lease secures the maximum long-term financial return.
Because that's the purpose.
That's the purpose.
Is there a second? Second. You have a second by Senator Driscoll? Is there further discussion? Any discussion? All in favor say aye.
So, yeah.
Further, go ahead,
So,
Mr. Vice Chair.
the problem is, I like the idea, but that's more of a substantive change. And I think, for me personally, I need to read through the entire act of admissions and get the specifics of what was changed in Idaho, so I understand it. So I think we ought to wait on this particular amendment because I'm just not ready to do it.
So, and Mr. Chairman, I'm fine with that. I would say let's get the amendment drafted up and have it ready. And here's why I think this is important. And it's not for the ag leases, and it's probably not for the mineral leases. But if we ever start to get into commercial leasing of school trust lands, I can guarantee you, the longer those lease guarantees are for somebody that wants to build facilities or something like that, provides much more long-term financial revenue to do that if we decide to go. And I know there's been several bills sponsored in the House to move some of those type of things. The current 10-year limitation would restrict us from being able to do that under our active admissions, as I see it now. Maybe I'm incorrect.
Well, and I would concur with that. In fact, I know that there's a bill out there coming up that does just exactly that. So all the more reason that, yeah, let's get it drafted and then we'll work through it.
Okay. What's that, Reverend Schwartz?
Thank you, Mr. Chairman. So I'm not ready to support this amendment. I might have one or two school sections in my mind at the moment. And whether or not ultimately this is how we proceed, I'd rather keep the language out of the active admission. And if we can deal with that on our own, but it may not, from my personal perspective, be the best thing, the best standard to mandate. Because there are other values besides strictly financial.
I mean, and I think that's a good point. Ultimately, the Board of Trustees, or the Board of State Land Commissioners, State Loan Investment Board, they're fiduciaries of these lands, and so ultimately, that's their obligation to do that very thing as well. So anyway, so we'll do that. We'll go ahead and let's draft up the amendment. And then, and we'll just, is there any, before we officially table this until the next meeting, is there any other amendments or anything else that you'd like LSO to do with respect to this bill draft?
No, I mean, so the next draft, we'll have Cap Fin as the sponsor. And we'll, and then.
And have that amendment prepared for discussion. Proposed amendment, not the amendment. Okay, anything else? Anything else on active admission? Nothing on the screen, nothing in the room. All right, is there any public, we didn't talk about, there's any public comment on active admission? Any public comment on active admission? None on the screen, none in the virtual room, or none in the room. With that, is there any other general public comment for today? Any other general public comment for today? Any in the room? None present. Any additional language or any additional considerations or discussion by the committee today? Seeing none on the screen and none present. Going once, going twice. All right, I'm about ready to adjourn the meeting. Do it. Meeting is adjourned. Next meeting is set for the November